And then it will be discussion of policies in Washington.
Well, let's do some scenario analysis with you. Donald Trump comes in, end of January, says, that's it, 10%, 20% blanket tariff. They're going to wait for the data. Will you wait for the data?
If I were on the Fed, I would argue cut rates, because that's going to be a tax and a headwind to the consumer. And what you're going to see in inflation is an artificial ingredient.
Kathy, do you agree that basically people are overestimating the inflationary impact of tariffs and some of these other potential policies?
No, I think it's obviously tariffs have that mixed impact of being a price shock on the one hand and negative for growth on the other hand. But I think this particular Fed has to be very conscious of lagging inflation, and as they did in the past. And I think they may be hyper aware of their the message that they send. So my bias would be to say that they go very cautiously from here, simply because the last thing they want to do is get accused of being behind the 8 ball on inflation.
Let's bring a couple things together here, Bob. The president's going to have dessert with Jerome Powell at the White House, 2 scoops of ice cream, no question about it. And he's going to go, let's do 2 things at once. We got to cut rates because I need a weaker dollar. At DXY 104, 105, the first thing out of his mouth is going to be, I need a weaker dollar because those foreigners are getting me. How do you get to a weaker dollar?
Well, that's going to be a tough one, because in theory, the Fed cutting rates takes the pressure off the dollar.
Right.
But when you know there's a huge stimulus plan coming and, somewhere down the road of some magnitude, you're not really going to take the steam out of the dollar, and you throw tariffs on top of it, the dollar's exceptionalism continues. I don't know how you get it down.
Do you think U.S. exceptionalism continues when you consider the global backdrop right now, the difficulties in Europe, in China, compared to, say, the United States? Do you think that continues?
Well, I feel right now when we talk to official institutions, there's a search on for what's the alternate reserve currency to the dollar, and there doesn't seem to be one out there right now.
With the exception of maybe gold, which is what we've seen so far this year, right?
Yes.
Massive run, massive run.
Bitcoin, come on. That
Record
was the
high
big,
on election night.
That was the big winner, right? So maybe that's the new reserve currency. That's what we were going to be, right?
That's what we saw.
Capital?
Yeah, apparently. Kathy, it's good to see you. As always, Kathy Jones there of Charles Schwab. Bob Michael's going to stick with us through the decision. Just to set up the scores for you with about 90 seconds to go, we'll start with equities after a historic run in this equity market. All-time highs on the S&P 500 this week, record highs on the NASDAQ 100 this week, moves we haven't seen on the Russell in several years, a move of almost 6% following the election in the United States of America. In the bond market, I think we should stress once again, Lisa, this is a very different bond market to the one on September 18th when the Federal Reserve reduced interest rates by 50 basis points. The 2-year had a 3 handle. The 10-year was trading in the 360s. We are 70 basis points higher since then.
And it came before the election, and that's when people are pointing to the fact that we are seeing just an incredible upside surprise to a whole host of economic features here. I do wonder, though, how they frame that increase that you've seen in the long end at a time where they are talking about balanced risk and ongoing weakening in the labor market. Is that true?
The data surprise to the upside.
Yes.
It's not just the politics.
Correct.
The 50 basis point cuts, some people believe, encourage the move in long end rates as well. Do they understand their responsibility in some of the moves we've seen?
Which is the reason why some people think that you are going to get another dissent from this rate decision. Potentially could be, again, 8-1.
10 seconds to go. Apparently this is an easy decision for the Federal Reserve. And the Federal Reserve decision we're looking for is an interest rate cut on the FOMC of about 25 basis points. With that decision, is Mike McKee.
You got it, John. A 1/4 point cut in the Fed's benchmark interest rate, a few changes to the statement, and that's about it from the Fed. The target range now 4.5 to 4.75%. There is no change to balance sheet policy. The decision this time unanimous, as September dissenter Mickey Bowman voted for this rate cut. Inflation, the statement says, has made progress, dropping the word further, toward the 2% target, but remains somewhat elevated. No longer included, the assertion that the committee has gained greater confidence that inflation is moving sustainably toward 2%. The economic assessment suggests a slightly weaker labor market, noting that since earlier this year, labor market conditions have generally eased and the unemployment rate has moved up. but remains low. Still, the statement repeats September's view that risks to achieving its employment and inflation goals are roughly in balance. The rate cut today is in support of its goals instead of September's in light of the progress on inflation and the balance of risks. Policymakers note again they will consider additional adjustments to their benchmark rate, but offer no further guidance beyond that. There is no mention of politics in the statement. That will be up to Chairman Powell in about a half hour.
And Mike McKee, it'll be up to you, sir, to ask the questions. How many questions do you expect are going to be leading with the events of this week and not this decision? How much of this is going to be about the politics at 2:30, Mike?
I would imagine quite a bit would be, and maybe we want to check the Las Vegas over-under line for that. But he's not going to say anything. He's not going to respond. So the question is, how many different ways can we ask, and how many different ways will he parry the question?
60 minutes of that. Looking forward to it. Michael McKee, you've got to run. I know that news conference begins in about 28 minutes' time, so no big changes to the statement. 25 basis point rate cut as expected. And when you see something like that, you're not looking for a big change in the market either. We stay higher on the S&P 500 by about 0.6%. Yields are still a little bit lower. On a 10-year, we're still down by 8 basis points, 435. And in foreign exchange, the euro gives up a little bit of the move, but still positive on the session. Lisa, 107.84 on euro dollar.
I think it's interesting that the Federal Reserve removed a reference to gaining confidence in inflation and saying that labor market conditions have generally eased. Honestly, to me, you're looking at this and on the margins, just setting the stage to potentially be a little less dovish. And that is the tone that I really am curious to hear in the press conference.
With us around the table, Bob Michael of JP Morgan, and a man who's seen it all before, the former Fed Vice Chair, Rich Clarida. Rich, I want to start with you, and not on the 25 basis point rate cut. You lived the tariffs of Trump in Volume 1 on the Federal Reserve. How did you handle it then? How much scenario analysis did you do ahead of time? How do you think this chairman's going to handle it in the months to come?
Well, the staff did good work, and some of that's in the public domain now, comes out every 5 years. The reality is, during my time at the Fed, inflation was running a little bit below target. The tariffs that were put in place made the headlines, but they didn't really push up inflation very much. You know, the devil will be in the details, I think, both on trade policy and fiscal policy. And I don't think they need to make any big decisions at this meeting or the next meeting about how they'll strategize for 2025.
Vice Chairman, I want to go to the politics of the moment. We're not going to get an answer from Jerome Powell, so we're going to get it from you right now. Harry Truman, 1950, before William McChesney Martin saved the day. I quote, President Truman, I hope the board will not allow the bottom to drop out from under securities. If that happens, that is exactly what Mr. Stalin wants. We've had this pressure before, and you and your brethren are going to get the pressure this time from President-elect Trump. How does the Fed deal with it?
I think they deal with it, Tom, the way that they did the last time, is just stick your, keep your focus on the goals of policy, price stability, maximum employment, and do what you think can best achieve those goals. You know, as you point out, opinions on the Fed, including from presidents, are not unheard of, and so we could see more of that. But I think the Powell Fed will just keep doing what they're doing.
How much is the market, though, speaking louder than any policy that's going to come down the pike? The fact that we've seen this massive rally in stocks and a sell-off in bonds that hasn't really hit risk assets. How much does that have to really cause the Fed to pause and even reconsider whether to cut rates again in December?
Good point. You know, I do think financial conditions are obviously an input to policy, but I would hope the Fed does not convey the impression that they're too sensitive to financial conditions, because they can rise and fall for a number of reasons. My own sense of what we're seeing this week is some of it is not so much more stimulus down the road as more certainty that the existing 2017 tax bill is going to be extended, right? So it's the absence of a tax hike as opposed to necessarily a tax cut. And I do think the deregulation piece of this is also important. So we've certainly seen a level set. I wouldn't necessarily extrapolate this from here. We'll just have to see how this plays out.
Either way, what we've heard is just the deficit is likely to expand.
Yeah.
It's been one of the main stories and consistency throughout all of the analysis. Does the Fed deal with that at all by signaling what they plan to do with their balance sheet? There's some speculation that, they could potentially monetize the debt to keep even keel economic conditions.
Well, certainly there would be that pressure, but I have high confidence that they would resist that. Look, the Fed is judged primarily on whether or not it achieves the inflation target. And when inflation's getting to 2%, that's really the focus. I think monetizing the debt is something that, if done on a sustained basis, is inconsistent with the inflation target. You do raise another point, though, which is a good one, Lisa, which is the fact that they are doing QT right now. You know, during my time there, the Fed stopped QT about the time that it cut rates in 2019. So the Powell Fed's continuing to shrink the balance sheet. They've given some indication about when they'll stop, but that, I think, will be a decision they'll need to make next year, and that could be in the context of pretty depressing budget numbers.
Bob, Michael, all of this seems very predictable. You get this from a former Fed official, Columbia professor as well. What is the surprise you're worried about into Q1, Q2?
Well, I guess my question for Rich is, what are they modeling? Are they modeling all the probabilities that fiscal stimulus could look like? Are they modeling the extension of the tax cuts? Or are they just modeling the existing economy?
Well, I guess the short answer is I don't know. We'll find out in 5 years. My sense, though, is certainly if I were there, what I would be focused on is a scenario where you may get a tariff, and then the question is that inflationary or is it a price level effect? Or in the wonkiness of central bankers, are there second round effects? Chris Waller, who I have enormous regard for, worked with Chris, gave a speech several months ago in which, or a Q&A maybe on Bloomberg, in which he said, look, a tariff is a one-time increase in the price level. It's not necessarily inflationary. So I think if I were there, I'd be wanting to see, will that play out in various scenarios? But beyond that,
Right.
The details will matter.
Well, my chart of the day is Jim Bianco had a fabulous chart showing the inflation, Bob Michael, coming out of 2021-22. And yeah, it's noodling along right now. The economists like Clarida are looking at the noodling along right now. And the public that just voted for Donald Trump is looking at the jump condition in inflation on a level change. Where are we going to be in 2025? Are we going to be looking at level change in the memory of it? Or are we going to be noodling along feeling happy?
Well, we're not going to feel happy because there's no deflation. We're not going to feel happy because by the end of 2025, there will be tariffs, and some of that will be passed along to the consumer. We're not going to be happy because I don't think there will be additional tax cuts, maybe on tips and overtime and corporate tax cuts in 2025. I think that's a 2026 issue. So we're not going to be real happy with further improvement in inflation. To me, I took the same thing Lisa took away. They dropped gaining confidence in inflation out of the statement. To me, that was an acknowledgement of a change in potential fiscal policy.
Do you think that that means potentially they won't cut even in December?
No, there is, how do you get from here to there?
Yeah.
It could be a number of quarters. You've got to preserve the economy in some sort of steady state. We're too high right now.
If I could jump off preserve, I think Jay Powell will want to preserve optionality for 2025. A lot can happen. It'll be more tricky in December because there's the dots, and so whatever the dots show, there will be questions about how confident the Fed is on that path. And I would suspect today he will begin to lay out a path to give themselves a lot of optionality in December as well.
Rich, this is important.
Yeah.
You think they begin to communicate or at least open the door to have the option to pause in December? And that starts today.
I do. It may be subtle, but I do.
Help me understand what that sounds like at 2:30. What does he say? What kind of language should we look for?
Since there is no SEP today, I would imagine, well, again, hypotheticals will know. A hypothetical would be a question about next year, and the chair will say something along the lines of it's too soon to make a judgment, and we'll be looking at the incoming assessment, and he'll remind folks that the rate path in the SEP is conditional on inflation continuing to come down. If there is a risk that it doesn't, that would factor into the rate path. So it's more, not so much about getting into scenario details as it is, look, the rate path depends on continued progress on inflation or disinflation.
If you are just joining us, welcome to the program. A 25 basis point reduction of the Federal Reserve, a news conference with Chairman Powell in about 20 minutes' time. Joining us now is Diane Swonk of KPMG. Diane, a 25 basis point reduction, and welcome to the program. At a time where the data is still holding up, jobless claims are still quite low, do they have the luxury of waiting, of setting up a pause in December?
Well, I do think they're going to be, exactly as everyone has said, that they want optionality. I think they're still going to cut again in December. That said, the Fed wants to start talking about calibrating rate cuts to the economy, and they're not going to be wanting to pull rate cuts, do as many rate cuts sequentially, I think, in 2025. And optionality, as Rich said, is going to be #1 issue because they don't know exactly what the policy will be, when policy will change, how it will affect the economy, and that is going to matter. Exactly as Rick stated, that the certainty on the dot plot in December is going to be really uncertainty. And I think one of the greatest challenges that the Fed now faces is communication. This is not a period where you can give a lot of forward guidance because of the uncertainty on the course of policy going forward.
Dan Swank, I was thunderstruck by the shift across the blue wall towards Mr. Trump. We all saw it. Frankly, we saw it out in Long Island, here in New York as well. There seem to be a haves and a have-nots here within this election. How does Mr. Powell address both groups into 2025? How does he aggregate and make a constructive policy for the people flat on their back that voted for Donald Trump?
Well, at the end of the day, and Rich has made this point, and I agree with them, at the end of the day, the Fed's job is price stability. There is deflation in some goods prices, so some goods prices are coming down. They're still elevated from where they were. I do worry about shelter costs and whether or not those can really come down like many would like, and that is a problem. And also insurance costs. Those are more structural in nature. But at the end of the day, it's the Fed's job, one way or the other, to get enough prices to fall to get to that price stability, but to get inflation to no longer be #1 issue. I think that's going to be more challenging as we get into 2026. I agree wholeheartedly that the bulk of the policy shifts that we see, especially in terms of fiscal policy, are not likely to hit till 2026. And I don't expect a lot more than the extension of the tax cuts that we had with maybe some additional corporate tax cuts, but we will see. And I think it will take some time. I don't think it's all going to be done in the first 100 days. The tariffs, as Rich said, are issues that can be a level change, but if you combine them with curbs on immigration at this time and actually have any kind of deportations along with that, that tends to both stem growth and stoke inflation in this environment. We are not where we were pre-pandemic, and certainly tariffs in sequential order along with retaliatory tariffs, that kind of a situation would be much harder for the Federal Reserve to deal with, and the pressure on the Fed is going to intensify if that occurs.
There's a lot of nodding around the table. I find it fascinating how little we understand inflation and exactly what's going to cause a real surge in it. And I do have to wonder, and Bob, I'll throw this to you because I know you think that the Fed should keep cutting and that there is weakness to be addressing. I am struck by the fact that there hasn't been a more marked slowdown in any of the economic data with high yields, with rates at the long end as high as they've gotten. Doesn't that tell us something about how restrictive or not that restrictive policy actually is at this level?
Well, I think it's unfair to say there are no signs of a slowdown. As I said, you look at new and existing home sales. Those are purely dependent on the level of rates currently because we know home prices aren't going to come back and they're quite high. And so new and existing home sales are down. They're going to decline further with this pop-up in rates. And as I said, in corporate America, you look at the amount of amend and extend and pick, there is a lot of corporate America that's struggling with the higher cost of funding, and a lot of that is floating rate. So for me, if you're at the Fed, you've got to step back and say, okay, we're also looking at performance of credit cards and auto loans and other things. We do continue to need to take some of the pressure off to ensure we have a soft landing. I'm not talking about going to 0, 2, or 3%. I'm just saying where we are currently around 5% is still a little bit too high.
I'm going to be the rude one today, the former vice chairman of the Federal Reserve System. This is Kyla Tausch over at CNN. Michael McKee passes this on to us. McKee insists that I'm as rude as I can be to Richard Clarida. There's speculation here after the Powell term. Your name is not mentioned. That's, I guess, the good news.
Yeah.
There's Kevin Hassett and Kevin Warsh as well. Those are two very different people. What kind of person do we need to run the Fed into the Trump administration? Do we need a monetary expert like you on DSGE, or can we use someone like Warsh who's more a part of the regulatory and Wall Street system?
Well, I would also throw in Chris Waller's name as well. Certainly be on my
Want to
list.
throw in Richard Clarett's name as well while we're here making some news?
Look, I think that there is no one cookie-cutter job description. I think that Jay Powell's been an incredibly successful Fed chair, Ben Bernanke, Janet Yellen, so you can certainly come from a background. What I would say about it is that in the world today, it's not just hiking and lowering rates. There's the communication piece we talked about. There is the supervision and regulatory piece that is not just only about banks. It's about how the economy functions. And so it requires a special skill set and a special person. But all the names you mentioned would be good choices.
I just wanted to cross over to Dan Swung just to fit in a final question before you run away, Dan. We always ask you this question. If you had a question for the chairman today in the news conference, Dan, what would it be?
It would be how much discussion was there about the labor market and the recent inflation numbers. I mean, that is where the tire meets the road in terms of where the next rate cut is going to be, and how much are they secure in the labor market weakness that we saw being transitory with regard to hurricanes and strikes. We know that part is transitory, but there is some signs that the labor market is slowing, and how concerned are they on that? The other issue I think is really important, one that we talk about all the time, that word that's out there, nonlinearity. What the Fed always worries about, and this gets to the issue of, when do rates have a bigger impact on the economy, is the nonlinear effects, I think, in both delinquencies, but also particularly in the business sector where we do see some floating rates out there. There is some stress now starting to show in the business sector, and I think that's a very important issue.
Dan, you're one of the best. It's always great to get some time with you. Dan Swunk there of KPMG. If you are just joining us, about 12, 13 minutes away from a news conference with Chairman Powell. Equities at the moment still near session highs, at all-time highs on the S&P 500. We're at 1.4% on the NASDAQ. That itself is a record as well, following a 25 basis point reduction at the Federal Reserve. Equities stay elevated. Not much price action off the back of this decision this afternoon, though. Joining us now is Matt Lazzetti over at Deutsche Bank. Matt, I want your thoughts on the outlook. And Matt, welcome to the program. Have you made any changes since the election this week? And if so, how many?
Yeah, thanks for having me. So we haven't really made any official changes to the outlook at this point. I think, we need to gain clarity on a number of things. How we're thinking about tax policy, the sequencing of that between trade and tariffs will be really important. But we did publish a note just giving kind of a guidepost of where we think the economy may be moving and where the Fed outlook may be moving for next year. And in particular, we do think that we could upgrade our growth forecast for next year probably into the 2.5% range, give or take or so. A labor market that is probably going to look a little bit tighter on the back of tax cuts that we're likely to see, easier financial conditions that we're likely to have, but also a Fed that is likely cutting rates less next year than we previously thought. And so, we are kind of outlined a scenario in which the Fed stops cutting rates above 4% next year.
Yeah, this is one comment from the recent note that you put out, that if it truly is a red sweep, then the likelihood is that the Fed funds rate remains above 4% by the end of next year, with growth and inflation revised upward. Matt, what would you have to see to make that your base case?
Look, I think we're close to that. I think it's just getting clarity on how we think the policy outlook is likely to evolve. I think we know a few things since the September meeting. One, labor market data, I think on balance have come in better and have diminished some of the downside risks that we've been worried about. Two, inflation data have come in hotter than anticipated. And so I think if the Fed were to have revised their forecast today, it's inflation higher, a labor market that is tighter. Three, financial conditions have eased considerably since the September meeting. And so I think as you look at all of that and just ignore the election for the time being, you've actually had an evolution in the data and financial conditions which would be hawkish for the Fed. Now, we overlay on top of that fiscal stimulus that may come via tax cuts, trade policy that could lift inflation next year. And I think undeniably together, these are just hawkish developments for the Fed.
Matt Lazzetti, George Sarvelis talked to him the other day. He's a little occupied with the collapse of the German government. But what does Deutsche Bank feel about the ability to steer to a weaker dollar, something President Trump would like?
Yeah, I'm not sure that that's actually something that's going to be a key policy objective of the Trump administration. I think some of their tone has changed on that. I think that they have emphasized that the reserve currency is a really important part, that they're making the U.S. economy a place for investment is a really important part from a policy perspective. Now, certainly, a weaker dollar could help on some of the trade objectives, but I don't anticipate kind of talking down the dollar is going to be a big part of the next administration.
Matt, we've been told so many times by so many people that the decision today was an easy one, and that maybe December will be an easy one. When do these decisions start to get hard?
So today was easy. I'm not sure December is going to be as easy.
Right.
If the incoming data continue to point to a labor market that looks resilient and downside risks have diminished, and if we get inflation data that continue to come in a little bit hotter, along with financial conditions that are easy, we are beginning to approach a range of kind of reasonable estimates of neutral from our perspective. We think neutral from a nominal rate perspective could be anywhere probably between 3.5% and 4%. So after this cut, perhaps the December one can come and they can still feel comfortable with that. But I really do think that the December meeting is the first one where we probably have a little bit more contentiousness around it, because they're approaching neutral, the data look fine, and you do have risks to the outlook where just from a risk management perspective, it could make some sense to slow the pace of cuts.
Rich, do you agree with that, especially with the fact that they have to come out with a statement of economic projections,
Yeah.
how that makes them, forces them to really write down, codify this idea of a neutral rate north of 4%?
Yeah, I think that scenario is certainly a plausible one, but the nuance I would offer is I could see a scenario where they get the funds rate down to around 4 and stay there, not because neutral's 4, but just inflation stuck at 2.5. I don't see the Powell Fed breaking a lot of China to get inflation down from 2.5 to 2 with rate hikes, but they may just pause at a funds rate in the low 4s because inflation's stuck at 2.5. So that's another way that delivers Matt's scenario.
Matt, what do you think of the idea of tariffs being inflationary versus not, right? I mean, what are you sort of looking at as the most inflationary aspects of policy that would be maybe a warning sign for the Federal Reserve?
Yeah, I think the complications for the Fed next year could be that we have demand-side policy in terms of tax cuts happening with an economy that is already strong, being coupled with supply-side policy via tariffs that would lift inflation. And both of those things being kind of giving you an inflationary outcome where it makes it difficult to disentangle what's happening from a demand side versus a supply-side story. Certainly if the Fed was able to identify, they could potentially look through the tariff effects on inflation. But I think that they were probably just less prone to do so for a few reasons. One, inflation is already above their target and is continuing to do so. Two, inflation expectations could be at risk of moving higher. And I think that this is primarily, or even more so, an issue if those tariffs are phased in over time. It makes it more difficult and complicated, I think, to identify the price level shock and makes you a little bit more worried about it factoring into inflation expectations.
So, Bob Michael, if I want to affect the Luzetti-Claire to move here in bonds, price up, yield down, how far out on duration do I want to be into 2025? Do I want to extend duration?
Yeah, I think you do here. I think there are a lot of things to do. That's the kind of interest we're seeing from clients. The municipal bond market is a large part of that. A lot of clients who own municipal bonds have ladders. Stuff is rolling off. Roll it out to 10 years. There's a lot going on in credit. Get out there and invest. You have to recognize there's been a pretty significant backup in yields. We don't know what fiscal policy will look like, and it sure looks like we're not going to see a lot before a year or so.
There's some people, Bob, worried about a buyer's strike emerging in the bond market, and I just wonder, with yields at these levels, do we just keep sucking capital away from the rest of the world here in the United States? Because if I'm thinking about the policy coming down the pike, from my perspective and many others as well, if you're investing in America, there's going to be policies to reward it. If you're exporting it, that's a very, very different scenario, trying to export into America. But do we just keep sucking capital away from the rest of the world?
Well, yesterday was the perfect evidence of that. There was every reason to hide from the bond market. You had a 30-year auction, and it went flawlessly.
Yeah.
You see the same thing, Rich?
I do. And in particular, look, we focus on the U.S., but it's a global bond market, and Treasury yields 4.5. We saw almost exactly a year ago, Treasury yields got to 5, and there was a voracious appetite to lock in those yields. And so I do think there's a range within which the growth in the Fed and the fiscal pit plays in. But beyond a certain point, it becomes very attractive to international investors.
So we retain the privilege of acting recklessly, as some people might say. Maybe.
Absolutely.
Kicking that can down the road.
Yeah, although I do wonder wonder what the consequence is of kicking the can down the road, and then Germany saying, hey, they're doing it, so we'll do it too. You know, this sounds like a good plan. France, hey, what about us? And all of a sudden you get yields rising higher, and how much does the bond market suck in the capital away from other risk assets? That's the question. No, I'm serious. That's one of my main questions.
Some of these European bond markets have learned they're not American, and that has been a painful lesson.
Which one in particular?
We've seen that in the UK. We had a little sprinkle of that in France. We saw that in the periphery a decade ago.
Rich,
well, I'm just saying the challenge for many European countries is the countries they'd like to invest on don't have a lot of debt outstanding, like Germany and Switzerland, and the countries that want to borrow have to pay a big premium. So, yeah.
I want to cross back over to Matt Lazzetti. Matt, just before you run, what's the best way of getting the chairman to answer a question about the election without answering a question about the election? Because that's all every journalist on the planet right now is thinking, and every single journalist in that news conference will be trying to do.
Yeah, I think it's a really difficult one. I think at the moment, Chair Powell has really no incentive to answer any question about what fiscal policy is going to look like. There's so much uncertainty. I think he's going to emphasize data dependence. I guess if you could do it through a few avenues, it would be one, how do they think about risks to the outlook as they look ahead, in terms of the policy outlook? That has to factor into how they're thinking about things. Two, I think it was interesting at the September meeting, he noted that the neutral rate has risen, quote unquote, significantly relative to the pre-COVID levels. And I would, just kind of think, if we're getting additional fiscal stimulus on that, how would he view the outlook for the neutral rate as evolving in that type of environment? But to be honest, I think it's difficult to get kind of a solid answer for him about what the election could mean for the outlook at this meeting.
Matt, appreciate your time, sir. Matt Lazzetti of Deutsche Bank. About 3 minutes to go until this news conference starts. Rich, you're perfectly placed to answer that question. What would you lean into in this news conference? If you were on the other side asking the questions, what would you lean on?
I think I'd ask the chair about financial conditions broadly versus the real funds rate, because it does seem over the last year, the committee at some points emphasizes tighter financial conditions. We saw that explicitly in the statement in both November and December of last year. More recently, they've emphasized, well, look, the funds rate's well above the rate of inflation, but at the same time, financial conditions have been getting easier. And it's not necessarily you have to pick one or the other, but get a sense of how he and the committee are thinking about that right now in a global market and in a U.S. market in which it's definitely risk on in the last several days and really for some time now.
I've asked this before, but I think it's so important. Where's the animal spirit into 2025? President Trump's going to go, 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 go. He's going to do that before January, whatever, the inauguration. How goosed is the economy going to be under Trump?
Well, I think there is that element at minimum because we did resolve some uncertainty, I think, about the extension of the existing. I would again remind you, if we extend the existing tax cuts, it's very expensive in terms of the way it's scored by the CBO, but it doesn't change anybody's tax rates relative to what they're paying now. I think the regulation, in particular certain sectors, energy and perhaps financial services, is sort of a one-time reassessment. I don't think you can keep that going. I think we are seeing a more or less rational, at least directionality-wise, reaction to markets. And to point on the dollar, strong dollar. I know some would like it weaker, but this is the dollar.
Here's the sum.
Yeah.
So, Bob, final question. We're about a minute, 90 seconds away from this press conference. How would you get him to answer something about his new balance of risks?
I'd ask the question we had gone back and forth on. Ask him, what is your staff modeling now? Because there's the current and expected set of data, and there's the majority probability that there's enormous fiscal stimulus coming down the pike a year from now. What do you model?
This has been a fantastic conversation, gents. Bob Michael and a former Fed Vice Chair, Richard Clarida. To the two of you, just absolutely brilliant. Just some takeaways from the last 30 minutes if you're just joining us. Richard Clarida talking about maybe finding some space to generate some optionality going into 2025. And I think there's a consensus around this table as well that the decision gets harder once you get to December, and that this one was an easy one and maybe December is a tricky one.
My big takeaway is that the Fed removed the reference in their statement to gaining confidence on inflation at the same time that our esteemed panelists are talking about opening the door in December to either not cutting rates or potentially going forward and maybe not cutting next year.
Are you ready for a 45-minute clinic on how to not answer questions? Are you ready for this?
I actually am so excited.
Is this a certified snooze fest?
No, absolutely not. tension's going to be pretty wild.
I think it's going to be one of those news conferences, and Mr. Clarida knows this well, where you have a sheet of paper in front of you, you've got your notes written down, and every time you get that question, 20 different versions of it, that sheet of paper comes up, and you read it verbatim, and hope they get bored of asking.
My favorite is when they have multiple sheets, when Jay Powell has multiple sheets, and someone asks a question, you see him going through the papers. Wait, where is, okay, there's the answer.
Have you ever written one of those questions answer sheets for the chairman?
I participated in discussions of press conference briefings, yes.
25 basis point reduction over at the Federal Reserve. Here's the chairman, Jay Powell.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong overall and has made significant progress toward our goals over the past 2 years. The labor market has cooled from its formerly overheated state and remains solid. Inflation has eased substantially from a peak of 7% to 2.1% as of September. We are committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. Today, the FOMC decided to take another step in reducing the degree of policy restraint by lowering our policy interest rate by a 1/4 percentage point. We continue to be confident that with an appropriate recalibration of our policy stance, strength in the economy and the labor market can be maintained, with inflation moving sustainably down to 2%. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose at an annual rate of 2.8% in the third quarter, about the same pace as in the second quarter. Growth of consumer spending has remained resilient, and investment in equipment and intangibles has strengthened. In contrast, activity in the housing sector has been weak. Overall, improving supply conditions have supported the strong performance of the U.S. economy over the past year. In the labor market, conditions remain solid. Payroll job gains have slowed from earlier in the year, averaging 104,000 per month over the past 3 months. This figure would have been somewhat higher were it not for the effects of labor strikes and hurricanes on employment in October. Regarding the hurricanes, let me extend our sympathies to all the families, businesses, and communities who have been harmed by these devastating storms. The unemployment rate is notably higher than it was a year ago, but it has edged down over the past 3 months and remains low at 4.1% in October. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed. Overall, a broad set of indicators suggest that conditions in the labor market are now less tight than just before the pandemic in 2019. The labor market is not a source of significant inflationary pressures. Inflation has eased significantly over the past 2 years. Total PCE prices rose 2.1% over the 12 months ending in September, excluding the volatile food and energy categories. Core PCE prices rose 2.7%. Overall, inflation has moved much closer to our 2% longer run goal, but core inflation remains somewhat elevated. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. We see the risks to achieving our employment and inflation goals as being roughly in balance, and we're attentive to the risks to both sides of our mandate. At today's meeting, the committee decided to lower the target range for the federal funds rate by a 1/4 percentage point to 4.5% to 4.75%. This further recalibration of our policy stance will help maintain the strength of the economy and the labor market and will continue to enable further progress on inflation as we move toward a more neutral stance over time. We know that reducing policy restraint too quickly could hinder progress on inflation. At the same time, reducing policy restraint too slowly could unduly weaken economic activity and employment. In considering additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. We are not on any preset course. We will continue to make our decisions meeting by meeting. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains strong and inflation is not sustainably moving toward 2%, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we can move more quickly. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to our discussion.
Thank you. Given the expectation that the election outcome will produce policies that would meaningfully impact the U.S. economy next year, how is the committee taking these proposals into account for upcoming decisions, including potentially the next one in December? And can you give us any more sense of how proactive or reactive the Fed is prepared to be to changes in economic policies with the next administration?
Sure. So let me say that in the near term, the election will have no effects on our policy decisions. As you know, many things affect the economy, and anyone who writes down forecasts in their job will tell you that the economy is quite difficult to forecast looking out past the very near term. Here, we don't know what the timing and substance of any policy changes will be. We therefore don't know what the effects on the economy would be, specifically whether and to what extent those policies would matter for the achievement of our goal variables, maximum employment and price stability. We don't guess, we don't speculate, and we don't assume. Now, just in principle, it's possible that any administration's policies or policies put in place by Congress could have economic effects that over time that would matter for our pursuit of our dual mandate goals. So we, along with countless other factors, forecasts of those economic effects would be included in our models of the economy and would be taken into account through that channel.
Nick.
Chair Powell, Nick Timros from the Wall Street Journal. Roughly 1 year ago, when the 10-year Treasury was flirting with 5% and 30-year mortgage rates were near 8%, you noted how higher borrowing costs, if they were sustained, could weigh on economic activity. Given that you've said you believe policy is restrictive and the Fed is now dialing back that restriction, are the growth risks presented by higher U.S. Treasury yields today any different from those you identified 1 year ago when inflation was still meaningfully above your target?
So I would just say this: we've watched the run up in bond rates, and it's nowhere near where it was, of course, a year ago. I guess the long run rates are well below that level. So we're watching that. Things have been moving around, and we'll see where they settle. I think it's too early to really say where they settle. Ultimately, I'm sure we've all read these decompositions of what, and I certainly have, but it's not really our job to provide our specific decomposition. I will say, though, that it appears that the moves are not principally about higher inflation expectations. They're really about a sense of more likelihood of stronger growth and perhaps less in the way of downside risks. So that's what they're about. We do take financial conditions into account if they're persistent and if they're material, then we'll certainly take them into account in our policy. But I would say we're not at that stage right now. It's just something that we're watching. And again, these things don't really have mainly to do with Fed policy, but to do with other factors in the economy.
if I could follow up, is the September SEP, are those rate projections still valid? Do they still seem relevant given where we are now?
You know, you get halfway through the cycle between the last set and the next set. I wouldn't want to comment one way or the other. You know, let's talk about the data we've gotten since the last meeting. So in the main, the economic activity data have been stronger than expected. The NIPA revision was stronger. Certainly the September employment report was stronger. The October report, not stronger. Retail sales stronger. So overall, though, I think you take away a sense of some of the downside risks to economic activity having been diminished with the NIPA revisions in particular. And so overall, feeling good about economic activity. So I think we would factor that in. At the same time, we got one inflation report, which it wasn't terrible, but it was a little higher than expected. So I think really the question is December, and you know, by December we'll have more data. I guess one more employment report, two more inflation reports, and lots of other data, and you know, we'll make a decision as we get to December.
Gina Smilik from the New York Times. Thanks for taking our questions, Chair Powell. When it comes to December, what will you be looking at specifically as you try to make that decision? And then as of the Fed's economic projections in September, you had written down 4 quarter-point interest rate cuts in 2025. Do you still think that those are likely? Is that sort of the baseline outlook at this point, or has that shifted? And if it shifted at all, can you give a little bit of detail as to why?
You know, we don't fill out an SEP, and I can't characterize one that wasn't filled out today. So I can't really speak for kind of exactly where the committee is. I will just say for December, we're going to be, again, at every meeting, we're going to be looking at the incoming data and how that affects the outlook. As you know, we're in the process of recalibrating from a fairly restrictive level at 5.33%. After today's move, we're down 75 basis points, and we're asking ourselves, is that where we need to be? You know that we're trying to steer between the risk of moving too quickly and perhaps undermining our progress on inflation, or moving too slowly and allowing the labor market to weaken too much. We're trying to be on a middle path where we can maintain the strength in the labor market while also enabling further progress on inflation. We think that's where we are, but that's the question we're going to be asking in September and in other meetings. And again, I can't really update you on the committee's thinking because we don't fill out an SEP at this meeting.
Yeah, totally appreciate that. I guess when it comes to your own thinking, do you think that a full percentage point of rate cuts in 2025 is a reasonable outlook?
Again, we're going to wait and see how things come in December. I mean, it's just, I would put it this way: we're on a path to a more neutral stance, and that's very much what we're on. That has not changed at all since September, you know, we're just going to have to see where the data lead us. We have, you know, a whole 6 weeks of data to look at to make that decision in December. Obviously, I'm not ruling it out or in, but you know, I would say, you know, I would say that, you know, again, we didn't update the SEP, so I'm not going to characterize, you know, where the committee would be.
Thanks, Howard Schneider with Reuters. I wondered if you could please elaborate, explain a little bit the 2 changes in the language of the statement here. In the first paragraph, when you say inflation has made progress, dropping the word further progress. And in the second paragraph, dropping the sentence that the committee had gained greater confidence that inflation was progressing towards its 2% goal. Is there any policy substance behind either of those changes in language? Is it meant to open the door to a December pause? Is it meant to communicate anything about the stickiness of core inflation the last 3 months?
Not really, no. So let me tell you what we were thinking. So the test of gaining further confidence was our test for the first rate cut, right? And so we met that test in September, and therefore we take that test out. If you leave it in, then it's new forward guidance. It's brand new forward guidance. What do you mean by it? Are you requiring yet further? We have to say yes or no at every meeting whether we've made further progress. The point is we have gained confidence that we're on a sustainable path down to 2%. So that I would tell you is what that's really all about. It's not meant to send a signal. Neither of those is meant to send a further signal. And saying further progress, it becomes a test. We don't want to be. We don't think it's a good time to be doing a lot of forward guidance. There's a fair amount of uncertainty in that. In what I've said, the path that we're on, we do know where the destination is, but we don't know the right pace, and we don't know exactly where the destination is. So the point is to find the right pace and the right destination as we go. And I think there's a fair amount of uncertainty about that. And you don't want to tie yourself up with guidance. You want to be able to make sensible decisions as you go.
Steve Leisman, CNBC. Mr. Chairman, you talked about higher rates, perhaps from an expectation of higher growth. You didn't talk about it in terms of expectations of higher deficits. Is that something you think might be behind the recent rise in interest rates, and are rising deficits a concern to you?
So we don't comment on fiscal policy, and again, I don't have a lot more to say on what's driving bond yields. In terms of policy changes, though, let me give you a sense of how this works in the ordinary case. Let's say Congress is considering a rewrite of the tax laws. It doesn't matter what's in the content. So we would follow that. At a certain point, we'd think we see the outline, so we'd start to model it. And then we'd wait, and then at a certain point, the staff would brief the FOMC and say, these are the likely effects. There's lots and lots of literature on the effects of tax policy changes on various parts of the economy. So we'd try to get smart on that, and then the law actually passes, and you'd start to put it. You probably run an alternative simulation before that happens, just to keep people trying to understand it. Then when it actually passes, it goes into the model, along with a million other things. So we have a very large economy. Many things are affecting it at any given time. And a law change of some kind would go in there, but it would go in. But it would, it's a process that takes some time. Clearly, the legislative process takes a lot of time. And of course, the real question is not the effect of that law. It's all of the policy changes that are happening. What's the net effect, and the overall effect on the economy at any given time? So I think that's a process that takes a lot of time, and that we go through all the time with every administration. Constantly, and this will be no different. But right now there's nothing to model right now. It's such an early stage. We don't know what the policies are, and once we know what they are, we won't have a sense of when they'll be implemented or all those sorts of things. So I think I would just say we're not doing that now, and all that will take time, and it will be very much regular order when we do that.
If I could just follow up on Nick's question. Are the current rates something you feel like you need to lean against, in that they go against the direction of policy by adding restriction to the economy, or do you just take them as a given and perhaps a signal that you should do less?
I just think the first question is, how long will they be sustained? If you remember the 5% 10-year, people were drawing massively important conclusions, only to find, 3 weeks later, the 10-year was 50 basis points lower. So, it's material changes in financial conditions that last, that are persistent, that really matter. And we don't know that about these. What we've seen so far, we're watching it, we're reading, we're doing the decompositions and reading others, but right now it's not a major factor in how we're thinking about things.
Chris. Thank you, Chris Rugaber at Associated Press. You mentioned the positive economic data that we've seen since the September meeting, including the revisions to things like savings, higher GDP growth. We saw a stock market jump yesterday. That's renewed some of the questions about why do many cuts at all in this with this backdrop.
So you're right. As I mentioned, and as you mentioned, the latest economic data have been strong, and that's, of course, a great thing and highly welcome. But, of course, our mandate is maximum employment and price stability, and we think that even with today's cut, policy is still restrictive. We understand it's not possible to say precisely how restrictive, but we feel that it is still restrictive. And if you look at our goal variables, the labor market has cooled a great deal from its overheated state of 2 years ago and is now essentially in balance. It is continuing to cool, albeit at a modest rate. And we don't need further cooling, we don't think, to achieve our inflation mandate. So that's the labor market. Inflation has moved down a great deal from its highs of 2 years ago, and we judged, as I mentioned, that it's on a sustainable path back to 2%. So the job's not done on inflation. But if you look at those two things, we judged in September that it was appropriate to begin to recalibrate our policy stance to reflect this progress, and today's decision is really another step in that process. Overall, as I mentioned, we believe that with an appropriate recalibration of our policy stance, we can maintain strength in the labor market even as our policy stance enables further progress toward our inflation goal.
Great. And just to follow up, what might cause you to pause rate cuts in December? What kind of economic data would lead you to that path? Thank you.
So we haven't, made any decision like that at all. But we're in the process, as I mentioned, of moving policy down, our stance down over time to more neutral level. And as a general matter, as we move ahead, we are prepared to adjust our assessments of the appropriate pace and destination as the outlook evolves. So, for example, if we were to see the labor market deteriorating, we'd be prepared to move more quickly. Alternatively, as we approach levels that are plausibly neutral or close to neutral, it may turn out to be appropriate to slow the pace at which we're dialing back restriction. Again, haven't made any decisions about that, but that's certainly a possibility. If you can think of it as similar to what we do with asset purchase, with asset runoff, with QT. So we reach a point where we slow the pace, much like an airplane reaching the airport slows down. And so we're thinking about it that way, but it's something that we're just beginning to think about.
Edward. Thanks, Chair Powell. So with the noise in the jobs reports that we've seen, and you look at the Fed's favorite inflation, PCE inflation, overall it's 2.1%, very close to the Fed's target, but core inflation is 2.7%, and it's been that way since July. So why doesn't this data give fuel to a rate pause for this meeting?
Well, so I think if you look at the 3 and 6 month, you're quoting the 12-month. So we look at all of them, right? But if you look at the 3 and 6 month core PCE, you'll see they're around 2.3%. So we look at all of them, and we also look at 12 as well. But what it's telling us is that we really have made significant progress, and we expect there to be bumps. For example, the last 3 months of last year, the core PCE readings were very, very low, probably unsustainably low. So that's why forecasts generally see a couple of upticks toward the end of the year. On the other hand, the January reading certainly looks like an example of residual seasonality, so that we saw last year. So when that falls out of the 12-month calculation in February, we should see. You see the progress on inflation, and you also look at the economy and you say, what is the inflation story now? Where's it coming from? So I point to a couple of things. One is the non-housing services and goods, which together make up 80% of the core PCE index, are back to the levels they were at the last time we had sustained 2% inflation, which happens to be in the early 2000s for a period of 5, 6, 7 years. So they're back to that level. What's not is housing services. So let's talk about housing services. Housing services is higher. What's going on there is, market rents, newly signed leases are experiencing very low inflation. And what's happening is older, leases that are turning over are taking several years to catch up to where market leases are, market rent leases are. So that's just a catch-up problem. It's not really reflecting current inflationary pressures. It's reflecting past inflationary pressures. So that's one thing. The other thing is I'd say look at the labor market, not a source of inflationary pressures. Where's it coming from? It's not a very tight economy. What is the story about inflation? You see that catch-up inflation also in insurance and several other areas. So you're seeing we're not declaring victory, obviously, but we feel like the story is very consistent with inflation continuing to come down on a bumpy path over the next couple of years and settling around 2%. That story is intact, and it won't be one or two really good data months or bad data months aren't going to really change the pattern at this point now that we're this far into the process.
So you're quickly trying to get to that neutral rate that you see, or do you foresee that you have some time to get there?
Nothing in the economic data suggests that the committee has any need to be in a hurry to get there. We are seeing strong economic activity. We are seeing ongoing strength in the labor market. We're watching that carefully, but we do see maintaining strength there. And so we think that the right way to find neutral, if you will, is carefully, patiently. Again, that's not meant to have a specific meaning, other than to the extent the economy remains strong, we have the ability to take advantage of that as we try to navigate that middle path between the two risks.
Hi, Chair Powell. Craig Torres from Bloomberg. 2 questions today. Did you learn anything about what Americans think about the economy from the election results? First question. Second question. I want to talk about some labor market indicators, and I do so with great respect for your attentiveness to the maximum employment side of the mandate, Chair Powell. So the unemployment rate has been at 4% or higher for 6 months. One of the broadest measures of unemployment is up about 0.5 point from a year ago. Compensation gains are sliding back. The quits rate, a signal of labor market dynamism, has been heading down to that bad neighborhood of the 20 teens. So you have put a marker at Jackson Hole saying any further cooling is unwelcome. It is cooling generally a little bit further. So at what point do we reach what you would describe as a shortfall from maximum employment? Thank you.
Sure. So on your first question, I'm not going to talk about anything that relates directly or indirectly to the election. On the second one, this is the great question, and it's the one we think about all the time. So I'll just say a couple things. There's nothing really surprising here. What we know is that the unemployment rate is low. We also know that it's moved up significantly from a year or so ago. So we've seen a big change upward in unemployment. Sometimes that has meant bad things. So far, it doesn't appear to be. It appears that I wouldn't say that the labor market has fully stabilized, because I do think it's continuing to very gradually cool. But it seems to be in a good place, and our policy, of course, is designed to keep it in that good place, to maintain the strength in the labor market while also enabling further progress on inflation. You mentioned a bunch of indicators, and you're right. The openings to unemployment rate is back to a normal level. I would characterize it more broadly as normalizing. You mentioned wages. Wages are still running just a bit above where they would need to be consistent with 2% inflation, unless productivity is going to remain at this high level. If we see productivity, more sustainably at these high levels, then that would sustain higher wage gains. So I would say, in fact, you can say it the other way, that wage increases are now consistent with 2% inflation given current productivity readings. But of course, the lore on productivity readings is whenever you see high readings, you should assume they're going to revert pretty quickly to the longer-term trend. That has always been the case for 50 years. But it may be that we're now 5 years. If you look at the NIPA revisions that came out a month ago, we're 5 years into a nice set of productivity readings, which are sustained and very healthy. But overall, it's a good labor market. We could talk about 20 different data series. We'll be looking at all of them, of course. We don't want the labor market to soften much from here. We don't think we need that to happen to get inflation back to 2%.
Victoria. Hi, Victoria Guido with Politico. Some of the president-elect's advisors have suggested that you should resign. If he asked you to leave, would you go?
No.
Can you follow up on, do you think that legally you're not required to leave?
No.
Mike?
Michael McKee from Bloomberg Radio and Television. You talk a lot about what the data are telling you and how you are dependent on the data, but in terms of forward-looking assessments of the economy, what are you hearing from CEOs or other officials around the country? What did you hear today from the regional bank presidents about what companies and consumers think about where the economy is going from here rather than looking backwards? And does that match up with what your forecasts have been and what you think the appropriate policy path should be?
So it's hard to characterize a really interesting set of discussions we had, and of course you'll see them in the minutes in 3 weeks. But I would say this: I think the comments from our Reserve Bank colleagues and from the CEOs that they talk to are pretty constructive on the economy right now. Pretty constructive, feeling that the labor market is back to normal, to the point where it's no longer that much a discussion topic in their worlds, whereas 2 years ago it was all they were talking about. So they feel like the labor market's in balance. People feel good about where the economy is. Demand is obviously pretty strong. And you're seeing 2.8% growth in the third quarter estimated. Maybe the year's 2.5%. This is a strong economy. It's actually remarkable how well the U.S. economy has been performing with strong growth, a strong labor market, inflation coming down. We're really performing better than any of our global peers, and I think that is reflected in what you hear from. What I hear people hear from CEOs. I don't get to talk to a lot of CEOs in my job, but I hear what others summarize from those. And of course, I hear the Reserve Bank presidents do a lot of that. And it's pretty constructive overall. Now, that's not to say there are areas of caution and things like that, but ultimately, overall, pretty positive.
Well, to follow up the areas of caution, if there were black clouds on the horizon that you identified as something you're watching, what would they be?
I think it's things like clearly geopolitical risks around the world are elevated, and just as clearly they've had relatively little effect on the U.S. economy. Now, that can change through the price of oil or otherwise, but people talk about those as something that's on the horizon all the time. But ultimately, if you look at the U.S. economy, its performance has been very good, and that's what we hear from business people, and expectation that will continue. If anything, people feel next year, I've heard this from several people, that next year could even be stronger than this year.
Andrew.
Hi, it's Andrew Ackerman with the Washington Post. I just wanted to follow up on the discussion earlier on fiscal policy. Your predecessors, Greenspan and Volcker, spoke up loudly when they thought large budget deficits endangered economic or financial stability. Will you do that too? And right now we're in a period of full employment. We have large budget deficits and debt at historic highs that are rising. Is that something you'd speak out against?
So, I have said many times, no more, no less than what the predecessors, you mentioned, U.S. federal government's fiscal policy is on an unsustainable path. The level of our debt relative to the economy is not unsustainable. The path is unsustainable. And we see that in, you've got a very large deficit you're at full employment, and that's expected to continue. So it's important that we, that to be dealt with. It is ultimately a threat to the economy. Now, I can say that. I don't have oversight. We don't have oversight over fiscal policy. I've said it on many occasions, just said it again.
Okay, thank you. I guess the other question is, to follow up on Victoria's question, do you believe that the president has the power to fire or demote you, and has the Fed determined the legality of a president demoting at will any of the other governors with leadership positions?
Not permitted under the law.
Not what?
Not permitted under the law.
Thank you.
Courtney.
Courtney Brown from Axios. In response to Howard's question, you said it wasn't an ideal time to give forward guidance because of the economic uncertainties. Can you lay out what some of those uncertainties are and whether or not it includes some of the proposals that the president-elect has put out on the campaign trail? Tariffs, for instance?
No, I was not referring to the new administration's policies at all, nor will I today. What I'm just saying is, as we look ahead, we know, and I mentioned this in my statement, that the risks are two-sided. I guess I should start by saying that we think that the economy and we think our policy are both in a very good place, And but as you look forward, you say, what are the risks? And one risk is that we would move too quickly and find ourselves having moved too quickly, and inflation comes back, and we lost our chance to get inflation back to 2%. So we have to avoid that risk, and to avoid that risk, that means you want to move carefully. The other risk is that we move too slowly, and that we allow the labor market to weaken too much and do unnecessary damage to the labor market and to people's working lives. That says don't get behind the curve. So these two things are the two risks that we have to manage, and so we're in the middle there. We try to be in the middle and deal with manage both of those. Again, the idea is to support the strength we have in the labor market and in the economy, but also with somewhat less restrictive but still restrictive policy, enable further progress toward our 2% inflation goal. This is a thing where we're meeting by meeting, we're going to be making our assessment of what the right path is. It's not as important. The precise timing of these things is not as important as the overall arc of them. And the arc of them is to move from where we are now to a sense of a more neutral policy. We don't know exactly where that is. We only know it by its works. We're pretty sure it's below where we are now. But as we move further, there will be more uncertainty about where that is, and we're going to move carefully as this goes on, so that we can increase the chances that we will get it right.
Simon.
Thank you, Chair Powell. Simon Rabinovich with The Economist. I know you don't want to share your decomposition of bond yields, but if you look at the break-evens, it is clear that longer-term inflation expectations do seem to have risen, up at about 2.5%, for example, on the 5-year. That's up half a point from when you cut in September. Do you have any concern at all that longer-term inflation expectations are de-anchoring, or put another way, are anchoring at a slightly higher level? Thanks.
So we would be concerned if we thought we saw longer-term inflation expectations anchoring at a higher level. That's not what we're seeing. We're still seeing, between surveys and market readings, broadly consistent with. I looked at the 5-year earlier today, and it's probably moved, but it's just not. It's kind of right where it's been, and also it's pretty close to consistent with 2% PCE inflation. So that's one that's been a traditional one that we look at a lot. But overall, expectations seem to be, and really have throughout this, in a place that's consistent with 2% inflation. But you're right to say we watch that very carefully, and we will not allow inflation expectations to drift upward. But that's really why we reacted so sharply back in 2022 was to avoid that.
Kelly.
Hi, Chair Powell. Kelly O'Grady, CBS News. We just talked about what you've heard from business leaders on the economy, but many average Americans are still not feeling the strength of the economy in their wallets. So what's your message to them on when they might expect relief?
So you're right that we say the economy is performing well, and it is, but we also know that people are still feeling the effects of high prices, for example. And the world went through a global inflation shock, and inflation went up everywhere, and it stays with you because the price level doesn't come back down. So what that takes is it takes some years of real wage gains for people to feel better, and that's what we're trying to create. And I think we're well on the road to creating that. Inflation has come way down. The economy is still strong here. Wages are moving up, but at a sustainable level. So it's just I think what needs to happen is happening, and for the most part has happened. But it'll be some time before people, regain their confidence and feel that. And, we don't tell people how to feel about the economy. We completely respect what they're feeling. Those feelings are true. They're accurate. We don't question them. We respect them.
And just a quick follow-up, President-elect Trump has been critical of your performance. Any concern about his influence on the Fed's independence?
I'm not going to get into any of the political things here today, but thank you.
Nancy. Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. What is your plan if we start to see stagflation?
Well, so that's the whole plan is not to have stagflation, so we don't have to deal with it. So that is actually our plan. It's of course a very difficult thing because anything you do with interest rates will hurt one side or the other, either the inflation mandate or the employment mandate. I would just say that we've been able to see inflation come down a whole lot, much closer to our goal, without the kind of sharp increase in unemployment that has often accompanied programs of disinflation. So, knock on wood, we've gotten this far without seeing a real weakening in the labor market, and we believe we can complete the inflation task while also keeping the labor market strong, and that, of course, is exactly what we're trying to do.
Can you rule out an interest rate hike next year?
No, I wouldn't rule anything out or in that far away, but that's certainly not our plan. I mean, our baseline expectation is that we'll continue to move gradually down towards neutral, that the economy will continue to grow at a healthy clip, and that the labor market will remain strong. If you look at our that will not change from the September SEP. That is our baseline forecast, and short of some exogenous event, that will continue to be our forecast for the foreseeable future. So, but ultimately, we're not in a world where we can afford to rule things out a full year in advance. There's just too much uncertainty in what we do.
Let's go to Jean for the last question.
Hi, Chair Powell. Jean Young with MNI Market News. I wanted to go back to a comment that you had made about Americans being quite unhappy about the cumulative price level rises over the past few years, even though now inflation is back on a path to 2%. Would it be appropriate for the Fed to undershoot for a while on its inflation goal under the average inflation targeting regime so people have a chance to catch up?
No, that's not the way our framework works. We're aiming for inflation at 2%. We did not think it would be appropriate to deliberately undershoot. And part of the problem there is that low inflation can be a problem too, in a way. But that's not part of our framework, and it's not something we're going to be looking at in our framework review. Thank you very much.
An absolutely fascinating news conference with Chairman Powell. Where do we start? Where do we end? A 25 basis point reduction for the Federal Reserve as anticipated, but some drama over the last 45 minutes or so. Let's start with the equity market. On the S&P 500, we look a little something like this at all-time highs, up 0.8%. On the NASDAQ, we're up by 1.6. At the moment, looking at the Russell, we're down by about 0.1%. Let's switch it up and get to the bond market, and we'll go through these yields. Let's look at yields at the moment, down 6 basis points on 2s and down about 11 on 10s. On the 30-year, we're down about 8 basis points at the moment. On policy, this was really, really subtle. Did they drop their easing bias? Not quite. Did they find a way to find some optionality? Without a doubt. Effectively endorsing a view that we've had around this table over the last few hours. As time goes by, these decisions get a whole lot harder. Reluctance to endorse the September forecast. Acknowledgement that downside risks have diminished. Awareness that White House policy could redefine the outlook. As anticipated, a lot of questions on one thing. This week's election. Take a listen.
In the near term, the election will have no effects on our policy decisions. Here, we don't know what the timing and substance of any policy changes will be. We therefore don't know what the effects on the economy would be, specifically whether and to what extent those policies would matter for the achievement of our goal variables, maximum employment, and price stability. We don't guess, we don't speculate, and we don't assume.
That's the takeaway on the election. The obvious follow-up to that question, are the September forecasts still valid? Take a listen.
I think you take away a sense of some of the downside risks to economic activity having been diminished with the NIPA revisions in particular. And so overall feeling good about economic activity. I think really the question is December, and by December we'll have more data. I guess one more employment report, two more inflation reports, and lots of other data, and we'll make a decision as we get to December.
So obviously that decision in December will be totally data dependent, but that sound you heard, just the door, slowly opening to a pause if they need to. Now that's policy. Let's talk about leadership. You want some tension in this news conference? Take a listen to this exchange from about 20 minutes ago.
Some of the president-elect's advisors have suggested that you should resign. If he asked you to leave, would you go?
No.
Can you follow up on, do you think that legally you're not required to leave?
No.
No, and then no again. And a follow-up question a little bit later in the news conference. The answer to that follow-up, Lisa, not permitted under the law.
Even demotion is not necessarily permitted under law. The interesting aspect of this, number one, he was very definitive. Number two, he had a clear answer. It was clear that he had looked at that law ahead of this meeting and that it was fresh on his mind. It seems like this is going to be a very interesting transcript that we get in 5 years.
There's two press conferences today. Gina Smilac, Colby Smith, Steve Leisman, and all asking adult questions about the economics. I went to Craig Torres after his question, our great historian on economics, and I said, Craig, finally. And with Craig Torres launching off, John, we got into the emotion of this election and Fed independence into 2025.
We've got to separate these two issues, haven't we? Policy for December, which seems highly dependent on recent data and incoming data between now and then the projections around policy, which still feels some way off at the moment. There's nothing to model, I think is basically what Chairman Powell said in that news conference. So let's park the politics just for a while, just park the policy. Based on the data we've had since that September meeting, and basically depending on the data we get when we go into December, that sounds like a Federal Reserve that's teeing us up for something that the former Vice Chair Richard Clara talked about in this program before that news conference started, that we could see Chairman Powell look to find some optionality going into December.
That is what the market was looking at. What I was looking at was a Fed funds futures, which actually, after pricing in a 95% chance of a Fed rate cut in December as recently as the end of October, was pricing in a 60% chance as recently as a few minutes ago as Jay Powell was talking. Key question is, how much does this turn up the volume on CPI that we get next Wednesday, especially given that he pinpointed just some stickiness in the latest inflation
There's
print.
something you said when the news conference was on, Lisa and I were talking about this, and you said, this is a Federal Reserve that prepared for this moment. The very fact that he responded in this fashion that he responded to the questions in such a direct way going into next year, it sets up some real tension for 2025 and perhaps even beyond.
Because this is not a Fed that is just being passive and hoping people don't ask the questions. This is a Fed that's very prepared. They were prepared in how they were going to answer it. They were prepared even for the yield move question, saying that we only take it into consideration when it has been that way for a prolonged period of time. Again, this is setting up tests for the market to take into consideration at a time when they are saying they're opening the door to responding by not necessarily cutting in December.
Equity markets right now, session highs, record highs on the S&P 500, up by 0.9%. Yesterday, a big sell-off in fixed income. TK, this afternoon, we're seeing a bit of a rally. Yields lower across the curve.
A bit of a rally. John, do you have your 6,000 banner ready? I mean, you got to have that SPX 6,000 banner ready.
What are we, TK? 17 points away?
Yeah,
we're not far away.
We can't do Dow 44,000 banner, but we can do SPX 6,000.
I'm sure
they get there.
The president-elect will be very interested in doing Dow whatever thousand through next year. I said earlier on in the program this morning, it's funny you mentioned this. Stuart Kaiser of Citi was sitting right there this morning, and he said, you know, TK likes the Dow. And I said, I'm trying to change that. And going into next year, I'm trying to change president-elect as well to make sure that maybe he shifts away from that to the S&P 500.
I think that you have an equal chance at both.
Which is no chance.
Exactly.
Which is no chance.
Here's my response. No.
Yeah, exactly. But what about if?
No.
No.
And I'm sure the president-elect would say the same thing. Rick Reeder joins us now from BlackRock, one of the very best in global fixed income and cross-asset in markets worldwide. Rick, welcome to the program. You followed that news conference. Let's just start with your first takeaway, Rick. What's your big one?
So first of all, like you say, there's some drama there, and I thought that was interesting. Listen, I think I agree with the comments that they have to introduce some balance, I think, in December. Listen, I think the takeaway is they still think rate is restrictive. I still think you got to get that funds rate down to 4-ish. I think that you're going to go in December. I think you got to get you got to be really careful about the mortgage rate in this country, which we could talk about. But I think they're going to go in December. I think he's got that's part of the plan. But then as you get into next year, listen, I mean, you've got what could be a pretty significant set of policy changes. And I think the dots, when you go back to the September forecast, I think you got to, really think about that and evaluate that. I think that's going to be one of the most fascinating things going forward is how do they adjust terminal rate from here? How do they adjust where they project growth to be when you're going to go through what could be some pretty significant evolution from here.
So, Rick, as I go through the calendar over at the Federal Reserve, there's 2 dates with some asterisks over the next 6 months or so, and those little stars in the corner of those dates mean you get some projections at those meetings. So the next one is December 18th, and then as we work forward into the following year, we're going to get a decision from the Federal Reserve in 2025 in the spring on March 19th. On March 19th, Rick, we'll have a new president who may be already coming forwards with some policies and some big tariffs. Rick, do you think it's still too early on March 19th to expect this Federal Reserve to bake in some policy from DJT, the former President-elect Donald Trump?
Can I also say that I will wait and see? Listen, I think that I think you're going to have to evaluate that policy. I mean, we're going to get more data on tariffs. We're going to get more data on how we deal with spending deficits. Listen, I think there's some extremes that get said when you go through an election campaign like this, how aggressive we'll be on tariffs, how aggressive we'll be on cutting spending. And then I think you're going to start to see some clarity. You're going to see, by the way, you're going to see what a cabinet looks like. You're going to see who the people are. You're going to have a sense for those personalities and then, what their disposition is with regard to policy. So yes, I think in March, then you're going to have, to evaluate that and have to evaluate what it means for the forward growth forecast.
That said, Rick, one thing really stood out to me in the press conference, and yes, it was the no, and the preparation for that question, but also this focus on inflation being a little bit stickier than in prior readings. And to me, that was notable because it seemed like they had left inflation for dead. That wasn't even part of the mandate. It was, sort of autopilot cutting until you sort of get to a certain place and then you wait and see. How much does this turn the volume up on CPI that comes out on Wednesday?
It does. I mean, it's going to, listen, I think, one man's opinion, or more our team's forecast, listen, we think most of the descent in inflation has happened. We think you've got tremendous goods deflation. Now you've got base effects that aren't a tailwind going forward. What does service inflation do from here? I mentioned it earlier. I think shelter's a really big deal, and part of why I think you got to what you've seen over the last month. You look at housing affordability is still a problem. Housing starts are low, building permits are low, existing home sales are low. You have a problem today. Shelters, you're not getting enough home building. You look at all the home builder earnings, pretty rough because they're subsidizing mortgages, they're subsidizing houses through their bottom line. Listen, I think you got to get the rate down. You got to get housing moving more efficiently. Right. And that, by the way, that'll bring shelter inflation down. But that's been the thing that's sticky. But yeah, I think we're going to focus on what these, in particular, I focus on service inflation. Where are we going to be over the next couple of months? And I think it's going to be pretty important. I think most of the benefit, you've seen it play out already.
Rick, it's away from your remit. I was talking with Eric Belchunas, our ETF ace. BlackRock's got an interest in Bitcoin moments from printing 77,000. Equities are moving, bonds are moving in the way we've discussed. What does Bitcoin at 77,000 signal to fixed income and to equities, and for that matter, to the dollar?
These are good questions, hard questions. Listen, I will say one thing. I mean, obviously what Bitcoin is reflecting is a potential change in policy and a more favorable disposition towards crypto. I think that's point one, and that's clearly the big driver. Second one that I'll throw out there that I think is robust. Listen, we got to deal with debt and deficits and what does it mean for currency going forward. And listen, I mean, it's a scarce asset. It's becoming more scarce. And I think, and I will say from doing a lot of client meetings, people more and more are thinking about real assets. People are thinking about, gosh, in a different world, what does it mean? We got to get our spending down because our debt is too large. Do I own some scarce assets, some real assets? And I think that's playing through, obviously alongside the bigger one being a more favorable disposition from policy in terms of where that is. But gosh, I hear more and more about real assets, not just crypto, but in other places.
Rick, I've got to follow on that. I really want to understand from your perspective whether you see signs at the moment of people pushing back because of the deficit. So let's take yesterday's price action as just a snapshot of where things are at. So we saw a big sell-off in fixed income. And typically, if this was EM, say, and we saw moves like that, and I was worried about the fiscal position of that country, we'd see the currency weakness too. But you didn't see that yesterday. You saw a lot of dollar strength. So I'm wondering from your perspective outside of that, whether you are already seeing signs of pushback, and whether you'd expect to see it pop up in the US dollar anytime soon, if at all.
So I think the first thing people react to is you got a change in policy, tariffs, stronger dollar generally, and I think that's a market tends to knee-jerk. Market usually can only focus on one thing at a time, and I think it was focused on that. I don't do a client meeting today where not the first or second question is about the debt, isn't about the debt of the country, the deficits we're running. I think this administration is going to have to address, this Congress is going to have to address. It's too much debt coming due. If you said to me next year, like Lisa said, we're going to be laser focused on inflation, we're also going to be laser focused on auctions because we're issuing so much debt every single week. Every client wants to know, and I think it gets to that question of why people are buying real assets, how they're thinking about. By the way, equities are an operating leverage machine on GDP. And, quite frankly, you think about what does well in this environment, equities still do well. But every client meeting I go to, people want to talk about the debt. And I think it is definitely going to become much, much more of the regular dialogue in everything we do investment. By the way, not just financial investors, corporate CEOs, CFOs, how they think about CapEx, R&D. I think it's going to be a big deal going forward.
Can you just elaborate on that in terms of when we'll actually see it in a more dramatic fashion? Because you can make a lot of arguments for why yields have gone up. And frankly, Jay Powell said, I'm not going to parse out what's what, but some of it could be deficit, some of it could be the political regime, some of it could be better than expected growth. I don't even know. I don't care. It's going to stop anyway. At what point do you say, this is real, and this is actually a risk premium that's being put on for the first time in a long time?
Yeah, so, I would say a couple of things. Listen, it's hard to parse any individual movement that takes place in markets. But I think more and more, by the way, you look at what's happened to the credit markets. Spreads keep tightening. I've said this before. If you go through some of the companies today, high free cash flow, don't borrow on the front end of the curve, don't have any financing, don't have a maturity wall. I think you think about the U.S. government, we threaten a default every couple of years, we borrow at the front end, and the immense size of bill coupons or bill auctions we do every week, coupon auctions we do every week. Listen, I think it is, that's part of why every auction you got to watch, is the market, particularly in the back end of the curve. Listen, I think there's going to continue to be a strong bid to, and by the way, part of why I like portfolios, clip a lot of yield in the front end, just keep clipping that yield. The back end, I think, is going to be a big focus going forward. Like you said, we've never had, I would argue, in the U.S., it's not just the amount of debt, it's the debt service. We're talking about interest rates. We used to print Treasury bills at 0%, 1%. Now we're printing huge-sized Treasury bills every week at high levels. So it's going to be a big focus. And is there one event? Listen, I think auctions are going to be worth watching. And I listen, the shape of the curve. I would say one last thing. And I think Jay Powell was very clear and right in this. Markets can be wrong a lot. We priced 2 hard landings already this year. Markets can get crazy extreme one way or the other. But I think you got to watch over time the premium we're paying in this country for the amount of debt that we're going to issue, what it means for the currency and what it means, for how much will people absorb, not just domestically, but internationally.
Rick, I've heard a couple of whispers, and I'd love your response to this, from a couple of banks. They're anticipating that maybe credit trades through treasuries, investment grade, U.S. corporate credit trading through treasuries. I'd love your view on that. Is that possible? Because for some companies, we're not that far away. Do you think that we could see that in the next 12 months?
So, Jonathan, I never thought if you go back a few years ago, I never thought, and we've talked about it years ago, remember we were funding companies at negative yield? Like, I never thought that would happen. Remember that in Europe? Like, we're lending coming in. I remember explaining to my kids, like, I'm lending money to companies at negative. I'm paying them to take my money. But, explaining why bunds where they are, it's hard to explain. Anyway, so is it possible? It's definitely possible. The supply-demand dynamics are quite different, and it's definitely possible. I mean, the spread tightening you're seeing across the board is pretty powerful. Listen, one thing, ultimately, taxing authority is a really big deal. And there's one thing that I think is hugely important for the next couple of years. There's been a massive transfer of money from the public sector to the private sector. The private sector has got, I think the number's $220 trillion of net worth. The asset coverage of the United States is pretty darn good. How do you get at that asset coverage? How do you get at that net worth to send some of that money back to the government versus what they've transferred to the private sector? And that's going to be the evolution that I think this administration is going to have to navigate.
John, your insight there is critical. At least 35 years ago, I had the privilege of hearing John Templeton say the same idea that credit would trade through full faith in credit. Then it was unbelievable. Now it's unbelievable, but it's a critical insight.
Yeah, but you heard what Rick said there, and it's really important. Through the pandemic, there was a massive transfer of money, Tom, and it was from the sovereign to corporate America, to individuals, to households, which is why what we've seen ultimately, because of policy coming out of the pandemic, is that balance sheets for corporates are better. Balance sheets from households were rock solid. And what got weaker? Where was the leverage? The sovereign. Now, Rick, you followed that up and said that ultimately that's going to have to be a source of revenue. But that's not the policy proposal. The policy proposal, as you know, is to drop corporate tax rates from 21 to 15 with conditions, which is domestic manufacturing. I get all of that, Rick. Are you basically saying that at some point we need to understand that that's what we need to do, even if it's not what we want to do? And, Rick, for that to happen, you need guardrails. You need constraining forces. And I don't see any sign of that from any policymakers in Washington. And ultimately, it means it needs to come from the market. And the question is, Rick, it's the question we've asked for a decade plus. Will the market actually provide those forces? Will they constrain the hopes of fiscal policymakers, the tax cut hopes from campaigning? Do you think the market will be a constraining factor or not?
The answer is yes. Listen, I think policy generally doesn't react. Hopefully I'm wrong in this case, but generally policy doesn't react till the shark is right next to the boat. And I think, the markets will usually tend to anticipate things. And by the way, often anticipate them, too early or wrong. But I think the markets are going to be a great barometer for what, policy needs to adjust to. So, I'm hoping it's not egregious in terms of how that manifests itself. And I will say one thing. We could debate tax policy, marginal tax rates. Listen, I think the U.S. economy, there's only one way that you bring the debt down. You got to outrun it. Nominal GDP, we have to grow. The economy's got to grow. There's a series of initiatives you can have. You can have fiscal spend as long as it's got velocity to it and that the economy's growing, and then the cost of the debt has to come down and the sheer size of the debt has to come down. And then we slowly bring the debt problem down in this country. But I think it has to be a whole series of initiatives. And quite frankly, policy needs to create confidence of investors, of the general populace, that they're moving the boat in that direction. And by the way, confidence is hugely powerful. You can do a tremendous amount. Your comment about emerging markets. The one thing U.S. has, and you look at the faith in the Fed and the faith in the confidence that will ultimately do the right thing. But I think that's going to be really critical going forward.
Rick, you're a money manager. Can we finish there on what you've been doing? Were you selling bonds yesterday?
No. No, not yesterday.
But you've been
listen,
selling.
I would just say, listen, without getting specific in terms of things we're doing, I think there was regulatory change, or I think there's potential regulatory change. I think the financials are interesting. I think fixed income products like mortgages are interesting when you change the regulatory dynamic around banks and their ability to buy different things. So, those assets have become more interesting. Listen, I think equities are rightly moving in the direction they should move with a series of initiatives that could stimulate growth here going forward. So, I like parts of the equity market. And that's been, and then, the other side of it is that, something that I'm just going to keep persisting on, the front to the belly of the curve, yielding assets, credit, securitized assets, Europe, the way you buy credit, et cetera. Like, if you just keep clipping this yield, it is, even if rates move up so much, you're still able to build portfolios. We have this ETF, BINC. You're still able to create this portfolio of 6.5% yield That's pretty spectacular with inflation running at 2.3%. So that's my key, is like, let's keep buying this yield and hold this yield in the front of the belly, and then let people take the risk further out the yield curve.
Rick, this was awesome. It's good to catch up with you, sir. Appreciate it. Rick Reeder of BlackRock. Where do you begin with that conversation? It's a lot to chew over.
Yeah, well, first of all, he was talking about inflation possibly being sticky even before what transpired in Washington, D.C. I love his response to you about, were you selling bonds? We like mortgages.
We like banks.
We like banks. We like stocks. But this, to me, is really the key debate, which is how much can you buy the front end, clip the coupon? Is this making cash great again, essentially, for people who want to sort of get some income on the margins, but then go into asset classes that are going to be less vulnerable to a potential inflationary shock?
It's just a guess, and I haven't heard directly. I'm not sure if the Trump administration is looking to make cash great again, but we'll see. I guess maybe that is a goal.
Well, maybe it's make crypto great again. Actually, I think that it's make dollar less great so that it is weaker, although it seems like that's somewhat contradictory.
Let's get to Mike McKee. Mike McKee was in that room, in that news conference, and Mike McKee, at some point there was some tension with Chairman Powell. Were you surprised?
No, I don't think anybody was surprised. We got about as much out of him as we thought we would get. On the issue of Donald Trump and the elections, he just answered with one word and then one sentence. No, he's not going to resign if asked, and it's not permitted by law for the president to demote anybody on the Fed. And there wasn't as many questions along those lines as maybe we thought there would be, because he was so definitive on those two answers. I think what you got today was two different news conference messages. One was to the people inside the Beltway here in Washington about his relationship with Donald Trump, and the other is to the markets, and Rick very well. The Fed does not know what it's going to do. There are a lot of cross currents coming in 2025. So if you think that the Fed is on some sort of path because of the last SEP and the last dot plot, you're going to probably be wrong. The Fed has a lot to keep an eye on, not just with the president, but with everything else going on in the world.
With respect to the message to the markets, he was asked about the fact that the Fed removed the reference to gaining confidence on inflation, and he basically said there's nothing to see here. It was just a semantic issue, that we already said that and we're not going to repeat it. Do you buy that?
I do, and that was the conclusion that not only I came to when I read the statement in the lockup, but that all the other reporters basically came to as well. We've seen this before. When they start changing policy, they give a rationale for that, to where we need to be. And then after that, they're already there. So they don't need to keep repeating that. They just took it out, as he said, for clarity.
Mike McKee on the latest in that news conference. Mike, we'll have a longer conversation tomorrow when you get back to New York City. What a news conference with Chairman Powell. Dom Constant with us now of Mizuho. Dom, welcome to the program. We'll just give you the opportunity to share your initial takes from that news conference, and then we'll get into it. What stood out for you?
It was pretty much as expected, in the sense that he's still committing to the easing cycle. I think the sort of new news might be where might they pause in the context of the new policy regime that we'll be getting with the change in administration. But the idea is, I think there are, subject to the data really shocking, they're kind of on an autopilot to get rates down to around 4% in the early part of next year, and then we take it from there. If they have to respond to policies that adjust the balance of risks, for example, then they'll figure that out then. But the election itself isn't really affecting what we thought anyway they were going to do.
Dominic, if the theme of a Trump administration is growth at any cost, pushing against all this is going to be a nominal GDP lift. When you sum things together with Steve Risciuto, do you just assume a run rate 5% nominal GDP, or can I even look for an animal spirit towards 6%?
Well, I definitely think there's an animal spirits thing out there that's pretty interesting. I mean, the only caveat is when we went through tariffs before, when they started to sort of hit, it wasn't clear in 2019 that the animal spirits were exactly kicking in, and the Fed had to get into extra easing mode by then. So I think there is certainly definitely uncertainty around that whole thing. Right now, though, the issue is the labor market, it's not great. I mean, employment growth is sort of stagnating. I would say the economy is been bifurcated. You've had some very strong sectors, some weak sectors, and if it wasn't for the latest, the election, we'd still be in a mode whereby the Fed would be preemptively trying to cut rates quite quickly to stop unemployment going up. So we can't forget that, and we're going to have a few more months whereby if animal spirits don't kick up, you might still well see unemployment rising above where the Fed expects it to be, and therefore some disappointment. I mean, growth itself is a bit of a lagging indicator, and it really reflects the average of the economy. It doesn't reflect the underlying weaknesses in some of the sectors.
If we expect the unexpected, is a euro through parity, or dare I say 103 maybe, and yen through 160, will it signal a new, resilient, and stronger dollar?
Well, I mean, it really should do. I mean, especially if you're going to start pricing for the tariffs. I mean, what we don't know is whether the tariff threat is just a threat or whether it's going to be enacted. If you are going to enact tariffs, then there is obviously the risk the dollar is going to basically go up, and that's a big part of that. And then you get into the instance of the tariff is obviously falling onto the exporters. The consumer is going to be somewhat protected. That's where we might end up getting. But Trump is Trump, and so it could well be just a big bargaining chip, and we might not get the full force of the tariffs. I would say one thing about tariffs, though, is we do actually need them. If he's genuine about his tax cuts and the modification to the tax law next year, you do need the tariffs to actually pay for that. I'm guessing we're going to get the tariffs in the end.
Dom, just putting the policy aside, there have been other changes that have happened in the past 3-4 weeks that also were addressed here. Yields have gone up because of economic surprises to the upside. Inflation on the margins has been slightly stickier. There have been questions about why long-term yields are so high, and frankly, why risk assets don't care, because they're basically treating it like it's for the right reason. Dom, at what point do these yields force the Fed to take notice in a way that they don't have to now? They can just dismiss it as a blip, potentially.
Well, I do think a lot of the move in yields is obviously being driven by term premium, what we call term premium, and there are good reasons for why term premium is rising. One of them is tariffs, but another one is obviously the fiscal supply. So that means you kind of get this sort of steepening pressure through the yield market, and it's obviously consistent with the deficit concerns that are being coming out of the new policy regime forthcoming. In terms of how that affects risk assets, it's really a balancing act. If you have term premium going up, normally all else equal, risk assets would suffer. However, if on the other side of that, you're getting a sort of higher level of growth, let's say because of the fiscal stimulus coming through, then that really does kind of easily overwhelm the impact of term premium. Term premium has been very low, so to expect it to sort of go up is not unreasonable. It's almost, if you like, normalizing by some models we look at. And if you can take a quid pro quo and say, well, look, we're going to have higher growth coming out of all of this, then there's no reason for risk assets to perform badly. And I think that's kind of where we are. So we're in the sort of, best of all possible worlds in the sense where risk assets are okay, and yes, long-term yields are rising, but they're not rising so much that they're going to sort of unravel the story for risk assets. And bear in mind, the Fed is in restrictive mode. So by the fact that they can reduce their short-term rates, it will help anchor the curve lower. So you may well have higher term premium, but if short rates are still falling at the other end, then the whole curve is somewhat getting anchored, which is actually quite good news. And it does avoid one of the problems we had last year, if you recall. I call it the Liz Truss moment, where if the Fed threatens higher yields at the front end and you have a term premium rising in terms of hurting the long end, that's really bad news for risk assets, because that kind of unravels both sides of the equation, so to speak.
You said a number of things there. One aspect is you said that the Fed is clearly in restrictive territory at this point, and it will be easing. Jay Powell actually maybe cast a little bit of question around just how restrictive they were, saying that they're trying to get down to a place and then adjust so they can figure out what that neutral rate is. Do you think that he was opening the door to pausing in December, to not necessarily cutting more for the rest of this year?
I sort of feel that they're pretty much on autopilot for a December cut. I definitely think he's opening the door to a pause, let's say, within the next 6 months. So they're not going to sort of run all the way down to 3%, which is where they have that neutral rate. But they could definitely pause around 4%. Pausing around 4.5% is a little premature, particularly since they haven't even seen, wouldn't have seen the new administration come in. So, to my mind, not yet is the pause, and therefore they can sort of plow through, into a Q1 easing and then pause then. In terms of neutral and where it is, obviously no one really knows where it is, but we've done some interesting work to suggest that if interest rates don't come down, employment in certain sectors will continue to slow and go negative, and that's this kind of preemptive aspect of why they want to bring down rates, and that's kind of where, why I feel that neutral is not here. It's probably not at 4%, and it's probably close to 3%, but we'll see in the end.
So what did Constable Ricciuto say about a run rate of non-farm payrolls? I mean, can you get non-farm payrolls permanent under 100,000, or can you even go to a negative statistic?
Well, I think, clearly you can, and I think that's the problem. I mean, Powell himself said the labour market has eased enough. You don't really want to have payrolls running 100,000 or so, and the reason, or less. The reason is because layoffs are still very low. The layoff rate is still running below 1.2% of the employed workforce. The idea before COVID, the layoff rate was in a range of 1.2 to 1.4%. So adjusting layoffs higher, which will be reflected, for example, in the claims data going higher, normalizing, if you like, with employment growth down in around 100,000 or so, you will see unemployment rate rising well above the Fed's forecast. So you have to have basically payrolls accelerating, or somehow cross your fingers and hope layoffs never actually go up. And we're in a new world where companies just won't fire people. And in a way, that comes back to the animal spirits. Animal spirits to either not lay off, or animal spirits to hire more people and get payrolls accelerating to keep the unemployment rate where it is, in line with where the Fed would like to see it in the medium term.
Hey, Dom, this was great. It's good to hear from you, sir. It's been too long. Dom Constant there of Mizuho on the Federal Reserve. We'll do this all over again in December, but the key one, I think, circle it on the calendar for 2025, March 19th. March 19th, spring of 2025, when they have to produce some new forecasts with some new policies in mind, maybe.
Especially as the Fed finishes out the first 100 days, it raises this real question: how many of the policy implementations have really affected the trajectory of the economy? And they can't use this as a punt. We'll see what we see. They'll have seen, and they'll have to react.
The Fed is reactionary. The market is anticipatory. The Fed is reacting to the data. This market is anticipating changes to policy. And a lot of that right now hinges on what happens with the House and whether we get this GOP sweep. From New York City, that does it for us. Thank you very much for choosing Bloomberg TV and radio. Coming up in the close, Romain will get you there with Kathy Wood of ARK Invest. From New York, this is Bloomberg.
and global leadership are on Bloomberg.
It was important that when we came into office, we looked at the books, we assessed the state of the economy. We needed to understand the damage that's been done, and that £22 billion black hole is a real problem that we've got to deal with, and make sure that we go through all the processes necessary for a properly thought-through budget.
Nobody covers the top global leaders like Bloomberg. Context changes everything.
Asia is a continent of contrast. The region is a nexus of rich cultural traditions and a vibrant hub of trailblazing innovation and modernity. How will it push the limits of technology even further?
Going to space should become as easy as, taking a flight.
If NASA is designing a lander, their approach is they're designing a Formula One car. So we take, say, a Jeep approach.
Minister, give us a sense of how you translate Korean
Magazine, plus global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenevec on Bloomberg Radio.
A very good afternoon, everybody. On this Fed Decision Day, this Thursday, November 7th, 2024, I'm Tim Stenevec. Carol Masser is out today. We are live on Bloomberg Radio, streaming on YouTube and Bloomberg Originals. We just heard it from Charlie. The Fed cutting its benchmark lending rate by a 0.25 percentage point Thursday, extending efforts to keep the U.S. economic expansion on solid footing. Stocks hitting a fresh all-time high. Treasury yields falling alongside the dollar. Jay Powell said the economy is strong, and he's refraining from signaling the Fed will skip cutting rates. We're going to have much more on the trade and Powell in just a minute. Still ahead, though, in just a few minutes, we're going to be joined by the founder, CEO, and CIO of ARK Invest, yes, Cathie Wood. She's going to join us for her first interview since the election. We're talking Trump, Elon, Tesla, and more. And speaking of Trump, his win is a tale of widespread discontent. Bloomberg Business Week editor Brad Stone joins us a little later with more. And from his social media network to real estate and crypto, the former president's return to the White House will give him power to leverage his array of assets. All that and more over the next hour or so. First up, though, we are focusing on the Fed because it did cut its benchmark lending rate by a 0.25 percentage point. It extended efforts to keep the U.S. economic expansion on solid footing. Officials voting unanimously to lower the federal funds rate to a range of 4.5% to 4.75%. The adjustment follows a larger half-point cut in September. Joining us now is Abigail Doolittle. She's Bloomberg News Markets correspondent. She joins us here in the Bloomberg Interactive Brokers studio. Ira Jersey is Bloomberg Intelligence Chief U.S. Interest Rate Strategist. He joins us from Bloomberg Intelligence headquarters in Princeton, New Jersey. Abigail, I'm going to get to the trade with you in just a second, but I want to start with you, Ira. And it's less about the path of rates, at least where I want to start. I want to talk a little bit about the way that politics came up and the way that Powell answered or didn't answer at the press conference today. The word no coming up quite a few times. What did you make of that?
We went through this in 2018 and 2019 when the Federal Reserve was hiking interest rates, and there was questions like Donald Trump said, I want to fire this guy. And of course, they got the White House counsel involved, and everyone was talking about whether or not the president could remove a chair of the Fed or even a Fed governor. And the answer is no. There is a way for that to occur, but it's very specific in the Federal Reserve Act about how that can be done, and it's similar to some of the other independent agencies. So keep in mind, there's a lot of people in the government who do not serve at the pleasure of the president. So only those people who serve at the pleasure of the president can be immediately removed. So
okay.
This isn't new, right? We went through this 5 years ago, and I guess some of the people in the press conference forgot that we had done this already.
Okay, but would you say, though, Ira, it's a little different now, given that Trump is president-elect, he's back, Powell was, selected by President Biden, and his term doesn't expire until halfway through the next president's administration?
Well, it's May 2026, so not quite halfway, but yeah, I take your point. But so the thing is that if Jay Powell doesn't want to leave as Fed chair, he doesn't have to. Now, can Donald Trump, have go into the media and complain about what the Federal Reserve is doing or not doing, whatever? Sure, that's possible. It's also possible that the Federal Reserve Act could be changed by Congress, right? The president can't unilaterally do that. There has to be legislation to change it, maybe to somehow or another reduce the independence of the Fed. I think that would be a mistake, quite frankly, because it has been shown that independent central banks tend to do a better job with monetary policy than central banks that don't have that have more political whims of elected officials. So, but that being said, that's really the only way that could happen. And maybe Jay Powell gets frustrated, throws throws up his hands and resigns. That's not impossible. But today, he said no, he's going to stay.
He was very quick. I think he was ready for that question. I think it's fair to say. I do want to go and play some of the press conference when he was asked about the election and its effect on policy decisions.
In the near term, the election will have no effects on our policy decisions. Here, we don't know what the timing and substance of any policy changes will be. We therefore don't know what the effects on the economy would be, specifically whether and to what extent those policies would matter for the achievement of our goal variables, maximum employment, and price stability. We don't guess, we don't speculate, and we don't assume.
We don't guess, we don't speculate, and we don't assume. I want to bring in Abigail Doolittle, Bloomberg News Markets correspondent, because we saw no shortage of speculation, guessing, and assumptions yesterday with the equity market reaction to a Donald Trump entering the White House again. What do you make of the way that Powell says, wait a second, we're going to take a step back and we're going to wait to see what happens?
Well, I think it's a fair answer. I mean, the Federal Reserve is a different animal, a different beast than the markets created up of all sorts of investors, whether they're institutional or retail. And he's also respecting the natural law of cause and effect. He's saying that we're not going to treat an effect that we don't know until we see what the cause is. So until we actually see the policies and what the effect is on the economy, it's not going to affect our policy. Markets, on the other hand, are making the assumption that President-elect Trump will do as was done before, cut taxes, and especially since there's the chance, a pretty solid chance at this point, looking at some of those House races that are close, that it will be a Republican trifecta, that significant tax cuts could be put into place, 15% corporate tax rate, which would flow right through to the economy, plus deregulation. That could really stimulate growth. So these gains that we're seeing for stocks today, the S&P 500 right now up about 0.7%. So we're looking at a better part of a 5% gain over the last 3 days, the best 3 days going back to November of 2022. Investors are telling you they are excited for what could turn out to be a hot economy.
Hey, Ira, come on back in here and sort of give us your thoughts on that, because whereas the Fed chair will not guess, will not speculate, and will not assume, if there is indeed a red sweep, or at least President-elect Trump is able to get through some of his policies, what does that mean for the Federal Reserve come next year?
Well, I think there's a number of things. I think for next year, there's probably very little, because even, President Trump takes office January 20th. It's going to take some time to get all of the policies through committees and then through Congress. And really, it's the 2026 and forward expectations and how those policies will affect the economy, after next year. So in many respects, like Jay Powell will only have a little tiny stub of the Trump policies to contend with when it comes to monetary policy. So near term, and Jay Powell even mentioned this today, near term, there's not going to really be any effect on how they forecast the economy over the next 6 months to a year, because there's not going to be any major policy changes. Now, that being said, I think the market is a discounting mechanism, and one of the reasons why you saw the pretty significant sell-off in treasuries over the last couple of weeks is, yes, the economic data was much better, but I think part of that was just the anticipation that Donald Trump would be elected president and the potential for the sweep by the Republicans. And because of that, the idea that you're going to have potentially more deficits, higher deficits, so therefore more treasury supply, plus on top of that, as Abigail said, potentially better growth going forward. So all of those things combined, I think, is one of the reasons why we're near 4.5% on 10-year treasuries right now instead of 3.5%.
Abigail, give us your view on the equity market reaction here. We are seeing stocks higher, off their best levels of the day, but in general, market reaction was pretty limited to this press conference.
It was, and I actually think that almost none of today's market action is about the Fed. If there's a Fed piece to the S&P 500 being up 0.75%, the NASDAQ being up 1.5%, the stocks up 2.3%, and the Russell 2000 down just a little bit, the banks giving back a little bit from yesterday's greater than 10% rally, it has to do with the fact, to the best of my ability to determine, that the Fed did not in any way say jump ahead, make conclusions that we don't know yet, that because we think that the Trump administration, the future Trump administration is going to stimulate growth, we are going to pare back on what we were planning on doing. If there had been any indication that they were planning for that in the future, we would see probably a different reaction from stocks, because then the assumption would be that cuts that are priced in for the future, that they wouldn't be happening as quickly. Instead, it's status quo. So the rally we have today is really still the election certainty and the Trump trade.
Abigail Doolittle, Bloomberg News markets correspondent. She's here in our Bloomberg Interactive Brokers studio. Ira Jersey, Bloomberg Intelligence Chief U.S. Interest Rate Strategist, joining us from Bloomberg Intelligence headquarters in Princeton, New Jersey. Coming up next, your countdown to the close. The closing bell starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Scarlet Food, taking you through the closing bell, a global simulcast. It starts right now. We're joined right now by Tim Stenovic in the radio booth. Carol Masser has the day off as we welcome our audiences across all of our platforms, television, radio, and YouTube. Of course, a couple days removed from the election and a strange Thursday special Fed decision.
Yeah, what do you make of that? I almost said Wednesday earlier.
I know, it's kind of confusing here, but obviously they needed some distance from the election. But you got your 25 basis points, Tim.
You got your 25 basis points, and you also got a decision by the American voters. We were concerned that we wouldn't have a decision from the American voters by the time this Federal Reserve met and by the time that we heard from Jay Powell. So turns out they did a pretty smart thing by moving the day by 1 day.
Yeah, but Jay Powell was very, very careful, of course, to make clear he was not going to comment at all on the political situation or on what the incoming administration, what policy they might affect. So it was effectively a no comment through much of it. And the press conference was a lot shorter and a lot more tense, by the way, than what we typically see.
Isn't that notable that what we're talking about now is less about the path forward for rates, at least, and more about the way that he answered questions about what he would do if asked to resign or if other members of the Federal Reserve were asked to move aside?
And I think that's going to change in a material way, maybe not at the December meeting, but when we get to next year, because a lot of this is the monetary policy decisions are indeed going to be driven by the fiscal policy decisions, even if Jay Powell doesn't want to touch that. But he is going to have to address that, at least behind closed doors, most likely at that next December meeting. And my guess is it certainly was a topic of conversation in the two-day meeting that we just came out of here today. Meanwhile, let's walk you through the market action here on the day. Interesting price moves. We're well off the highs of the day, but the S&P 500 holding on to a record high, up about 40 points or about 0.7%. The NASDAQ composite and the NASDAQ 100 each up about 1.5% on the day. That's going to be good enough for a record high there. You see the Dow. The Dow had been trading at a record high for a good portion of the day. At one point, it was above right around that 43,800 level, but of course, it gave back a lot of that. And there you see the Russell sitting this one out a little bit, although it had shown a little bit of strength earlier in the session. Closing out the day, Tim, down 0.4%.
Hey, we're still in the midst of earnings season. It's not all about the Fed and the election. I'm watching what's going on over at Redfin right now. In terms of that outlook, the company sees a fourth quarter net loss between $25 and $32 million. That's coming above estimates of $24.1 million. The company says third quarter adjusted EBITDA came in at $3.95 million. Estimates were for $9.24 million. The company says third quarter revenue came in below estimates at $278 million. Estimates were for $281.1 million. Shares right now bouncing around a little bit, but about 3% to the downside.
All right, I'm taking a look at Expedia because that company just came out with results as well. Third quarter adjusted EPS beating analyst estimates, $6.13, 3 cents higher than what was anticipated. Revenue came in a little bit lighter, $4.06 billion. Analysts were looking for $4.11 billion. But in terms of its full year guidance, Expedia, the online travel company, did raise its full year guidance. So we are looking at brighter skies, at least when it comes to the outlook, and that stock marginally higher. Actually, it's bouncing around at the moment here. There's also, in addition, a CFO transition as well taking place at the company.
Yeah, this is interesting too, and we should point out, I think we are expected to get some results out of Airbnb a little bit later tonight, so maybe we'll get a little bit more color here on the health of the travel industry. It gets to this idea, though, too, when we talk about the beneficiaries here of the big travel boom, that revenge travel, and whether that has ebbed. This raises a big question here, not so much about how they perform this quarter, but whether they can give some guidance longer term that will please investors. Tim?
Yeah. I mean, look, return of business travel, Airbnb certainly talked up the idea of people using Airbnb for business travel. The company itself has a policy of remote work, so in a sense saying, hey, you guys should do what we're telling everybody else to do.
Yeah.
But at the same time, since everyone is returning to the office, apart from Airbnb employees, does that affect the company?
Yeah, Airbnb was also very popular for people who were combining work trips with vacation trips because they were able to do more of that. And of course, as we go back to a more conventional work situation, that probably requires less of those long-term, rentals at Airbnb places.
Yeah. That's why I was surprised to see. I was surprised to see Romaine today after a few days in Detroit doing election stuff.
Yeah, me too.
Not
Tim.
extending that trip.
Yeah, trust me too, man. I tried to stay anyway. I was going to take a trip over to Windsor, Canada, but we need to take the trip right now into those earnings out of Airbnb, crossing the wire right now. The red headline on the Bloomberg terminal is about the fourth quarter outlook. The company's seeing fourth quarter growth in nights booked above 8.5%. The street was looking for 7.7%. That's the guidance for the fourth quarter. For the quarter that we just ended, the third quarter, gross booking value coming in above estimates at $20.1 billion. EPS, $2.13. The street was looking for $2.15. Adjusted EBITDA above estimates at $1.96 billion. Revenue also coming in slightly above estimates here. And we're going to go back to the forecast here. So for the fourth quarter, they are saying that revenue in the fourth quarter, they're looking at a range of $2.39 to $2.44 billion. The street was looking for $2.42. So the top end of that range would beat that.
And just some commentary in the letter to shareholders. Airbnb saying that's building on robust momentum in September, off to a great start in the fourth quarter, citing strong demand trends across core as well as expansion markets. So again, to answer at least part of your question about what's going on in travel demand, so far, at least for a company like Airbnb, it looks like it has persisted.
I'm going to pose a question here, too, because it's interesting to see Expedia down, Airbnb up. And I think we had this conversation a few weeks ago when some other earnings were out. This idea that people aren't necessarily using these aggregator platforms to the same extent that they're booking either directly through the airlines or through the hotel websites, or if you're a platform like Airbnb, maybe there. And I wonder if that has an effect on sites like Booking, Expedia, et cetera.
Yeah, I think that's a really good point. I mean, consumers sometimes I know face challenges when they're trying to change a ticket. Now that it's easier to change a ticket if you do it through a third party versus if you're doing it right through that platform. One thing that I also took away from just a brief glance at Airbnb's release is about hosting versus staying using Airbnb. And you have to remember, this is a two-sided market here. Airbnb has to appeal to hosts to list their listings with the app, and also has to appeal to people looking for places to stay. What Airbnb is trying to do now is say that we want to make hosting as popular as actually traveling with Airbnb, as popular as staying in Airbnb, indicating to me that they're really trying to make the hosting experience better so people list with Airbnb rather than competing platforms.
All right, just a quick mention here of Lucid, the car maker, maintaining its full-year production forecast, still sees full-year production of about 9,000 vehicles, but for the third quarter, it did report a loss, an adjusted loss of 28 cents a share, slightly more narrow than what analysts had been anticipating. Revenue, $200 million. Analysts were looking for just under 197.
Speaking of EVs, Rivian also out with its results right now. 3Q production coming in at about 13,157 vehicles above estimates. Deliveries relatively in line at about 10,000. The company posting revenue of about $874 million. That's a miss. The street was looking for $980 million. And we're also learning right now that the company's loss per share coming in at about 99 cents a share. The street was looking for a loss of 92 cents a share. So a miss on revenue, a worse than expected loss per share. But at least right now, it does look like some of the production and delivery numbers came in either at or slightly above street estimates. Tim.
Okay, let's look at what's going on with Block, formerly known as Square. Third quarter net revenue coming in below estimates at $5.98 billion. Estimates were for $6.24 billion. The company sees a fiscal year adjusted EBITDA at $3 billion. It saw $2.9 billion. The estimate was for $2.92, so a beat there. The company also sees third quarter adjusted operating income at $1.56 billion. It saw $1.44 billion. The estimate was for $1.46 billion. Still shares moving lower in the after hours by about 7%.
All right, and we also have Pinterest, the social media network, reporting results. Let's start with the third quarter. Adjusted EBITDA, $242 million, beating the average analyst estimate, along with the third quarter adjusted EPS and revenue, also higher than anticipated. For the fourth quarter, this quarter, Pinterest sees revenue of anywhere from $1.13 billion to $1.15 billion, and at the high end, that matches the consensus estimate. So the outlook, certainly the range, is lower than the median estimate. And in addition, its active users, monthly active users for the third quarter, 537 million. That is higher than what had been anticipated of 532.4 million.
Affirm out now with their results here. Of course, this is basically the fintech company, if you will. In the company's fiscal first quarter, revenue coming in at about $698 million. That's up 41% year over year and slightly above street estimates. Here's your guidance going forward, though. 2Q revenue, the company sees a range of 770 to 810 million. The street was looking for an average of about 783. Gross merchandise volume also expected to be slightly higher as well. Tim. All right, we actually got a few other earnings that we do want to get to here on a very busy day. Of course, a Fed day and a chance to catch up with some of the biggest investors out there. That does it for our cross-platform coverage of the market close on Bloomberg Television, radio, and YouTube. But we're actually going to stick with our radio simulcast and Tim Stenovec, who's sitting down right now with Kathy Wood, the CEO and CIO of ARK Invest.
Hey, thanks so much, Romaine. Do appreciate it. We are very pleased to have Kathy Wood for her first interview since the election of Donald Trump earlier this week. Kathy, shares of your flagship fund, the ARK Innovation ETF, surged more than 8% on Wednesday. It was the best day in more than a year. Part of the risk-on trade that we saw on optimism of a second term for Donald Trump in the White House. And that's where I want to start with you, because when you were back on with us in October, you indicated, without actually saying the former president's name, that you preferred a President Trump over a President Harris, strictly from the standpoint of the candidate who you saw would ease the regulatory environment. So here we are. What does another Trump administration mean for you and the companies that ARK invests in?
Okay, well, thank you for having me on your show, Tim. Yes, regulation, critical. I think the regulations that have been creeping into the system, actually, they started to creep in. They've just flooded the system and really gummed it up. So the biggest regulatory issues have been around the SEC, especially when it comes to digital assets or crypto legislation, and the FTC as it relates to M&A activity. I think both there are going to be big changes there, and that is going to be the beginning, I think, of a lot of regulatory changes. In his first administration, President Trump basically said, for every regulation you want to introduce, anyone in my administration, you must get rid of two. I think it's going to be maybe more dramatic than that this time around. And I also think having Elon Musk, who I think today announced that he'd like to name a new department, the Department of Government Efficiency, get that, D-O-G-E, Doge. I think he's going to come into the administration. I don't think he'll be a formal part of the administration. He'll be more in an oversight role, as I understand. Yeah.
Well, hey, Kathy, I want to jump in here because you mentioned a few things that I want to follow up on. One is Elon Musk. Have you talked to Elon since the election?
No, I have not talked to him since the election. I did see on X that he was part of the family as they were taking the picture around President Trump's acceptance speech. So, I know he's obviously had a tremendous impact on the election. I think he had X made a big difference, and his ideas around government efficiency, which will revolve importantly around technology. Artificial intelligence is is doing wonders for the most bureaucratic organizations out there. We know from Palantir that it is having a tremendous impact on insurance companies, underwriting process timelines dropping from 2 weeks to 3 hours. And even in the military, Maven, Palantir's working on Maven with the DoD for targeting the enemy. They have shrunk that department. They don't need as many people. They've gone from 2,000 to 20 people.
Right.
Which it's pretty amazing what's going on. And I think we'll see a lot of attrition. Any employee leaving the government probably will not be replaced.
Okay,
I don't think he'll. I don't think he'll do $2 trillion in government spending savings in 1 year. That might be a 5 to 10 year. And I think between technology and attrition and lower regulations, maybe the abolition of certain departments, that they'll go a long way.
So you don't see him serving a formal role, but still overseeing some sort of Department of Government efficiency in an informal way? Help me understand what you see him doing, and whether or not that could be some sort of threat to, he's a very busy man.
Yes, he's an unbelievable, he's the inventor of our age. I think I said that in 2015 for the first time when I was on your show with Carol Masser at the time. He is the inventor of our age, and he comes into a problem, assesses it with first principles thinking, doesn't care how things have been done, and comes back with ingenious solutions to big problems, whether it's autonomous mobility in the autonomous taxi space, or in the healthcare space, Neuralink. He's in the social network space, X, in AI, XAI, but and a lot of people say, and SpaceX, of course, the entire exploration going to Mars. I think a lot of people can't believe he can do this, but again, he cuts to the quick. And first principles thinking, and surrounds himself with brilliant people who really want to solve the hardest problems in the world. And that's part of the secret to his success. Very high standards, and people who want to be held accountable to very high standards and want to really transform the world.
Hey, we're going to get back to Elon and specifically Tesla in a few minutes, but I want to go back to something that you mentioned at the top of our interview, Kathy, and that's the idea of some of the regulatory challenges that you said have cropped up over the last couple of years and during the Biden administration, specifically with regard to the FTC and the SEC not being present in a second Trump administration. How do you think the Trump regime will approach financial regulation, given that he's vowed to replace SEC Chair Gary Gensler? What does that look like?
Well, I think first, as it relates to crypto or digital asset regulation, they're going to replace Gary Gensler with someone who is much more open-minded, I would say, and will let the legislative process go to work. And the SEC is supposed to regulate, enforce laws. They're not supposed to create laws by enforcement, which is what Gary Gensler was doing. So I think that's going to be important. I also think if you look at the public equity markets, I think the number of public companies out there right now has been cut in half in the last 15, 20 years. The regulatory nightmare of being a public company has kept leaders of companies basically saying, if I don't have to go public, I am not going public. And so I think we're going to see a lot more work in that regard to give, the average investor a shot at some of these moonshots. So I think that's going to become very important. As far as the FTC, the antitrust has gone way too far. They were denying mergers and acquisitions that really the companies were tangential to one another. They weren't even really in the same market. So we're seeing, and yet at the same time, we've seen these megatech companies grow into, massive organizations and dominating their market. So they were denying mergers and acquisitions for, think about JetBlue and Spirit Airlines.
Yeah.
That was ridiculous. That was in the same industry, but one is going bankrupt now because they wouldn't allow that M&A. They were just dogmatic about it and didn't show to us at least any common sense.
So let's jump in. I just want to jump in because we don't have a ton of time with you, and I want to make sure we get to a lot, Kathy. So forgive me, please. You also mentioned last time you were on with us, you weren't wild about the idea of tariffs. Since then, President Trump said that tariff is the most beautiful word in the dictionary. Do you think he will follow through with his threat of broad tariffs? And how are you preparing and changing your investment style given the threat of tariffs?
Yeah, I'd love to talk about that because we've gotten more information. I think the way the president is looking at this is if he puts in place tariffs, the other side of that will be income tax and corporate tax cuts. And if you think about it, this is how America started. President George Washington, we had no income tax back then. All the taxes were in the form of tariffs. I do think that they're not going to be, crazy tariffs. They're going to be much more thoughtful and really focused away from our free trade agreement partners and towards those countries that have not been really letting our companies play on a level playing field within their countries. So I think there's going to be a lot of negotiation around that, really, really helping us. But I do think tax cuts, personal and corporate tax cuts, are going to be much more important than tariffs.
Okay.
In terms of the growth engine that this economy needs. I'll comment on just a couple of other things. I know he wants a weak dollar, but if he puts in place the deregulation and the tax cuts that we expect, the dollar's probably going up. And this reminds me very much of the early Reagan years. It's fascinating what's going on, except the first couple of years of the Reagan administration, he had to deal with back-to-back recessions because Volcker was, raising interest rates to 15% plus. We've done that. Trump does not have to face that. We think that the Fed went too far. I think the Fed today even says it's going to continue to unwind a restrictive monetary policy. And I think it's important, too, because what we expect now is there will be a lot of delayed activity as consumers and businesses try and figure out, okay, how low are taxes going and how is the world going to change? Am I going to get a better deal? So we're going to need lower interest rates. However, if we get the growth beyond that tax cuts and these other measures are going to cause, the dollar will probably go up. And so I think that will be a surprise, but it's an anti-inflationary force as well. And we're seeing commodities react to the dollar going up now in anticipation of these interesting policies. And then I'd love to just say one other thing. A lot of people talk about the deficit, and it is a big deficit in the middle of it's a rolling recession, but this deficit is worse than the worst deficit that Reagan faced at 5.5% of GDP. How did he get out of that and Clinton following beyond him? More through growth, not through tax increases. And you can add on top of that government spending restraint. So, this is going to be extremely healthy and very important, I think, for the stock market. The stock market has through a period here of great concentration towards a few stocks. And now we think, and we've seen it in the last few days, there's going to be a broadening out. And we're very excited about that.
We'll talk about that in just a minute. If you're just now joining us, we're joined by Kathy Wood. She's the founder, CEO, and CIO of ARK Invest. She joins us from St. Petersburg, Florida. Kathy, I want to talk one more question on regulation, and then we'll get to a little more on Tesla and Elon and some of the big themes that you're seeing. I'm wondering about from you what you think specifically in terms of financial assets is being held back by regulators. Like, what financial assets do you think should be opened up to the trading masses that haven't been?
Well, it's interesting. We launched a venture fund, and we put it in an interval fund structure, which is regulated by the SEC, and we've had access to OpenAI, Anthropic, Databricks, SpaceX, Epic, Discord, lots of companies that young people who don't meet the income or net worth thresholds that venture funds require, they can get into our venture fund because it's in the interval fund structure. I think we're going to see a much more of a loosening up. You know why we can offer our fund to retail investors for as little as $500? It's because we're not taking a carry. We're not charging carried interest, 20% of profits. We do charge a higher fee than you'd get with public companies. And I think we're going to see the democratization increasingly of private companies as well. I think this administration will advocate for that, and will lower regulations, whether it's Sarbanes-Oxley, but regulations that have tied companies in knots. It's very expensive to be a public company now, and so for any company, as the digital world and the physical world converge, and we think that's big theme going ahead. We're going to need the kind of capital raising that the public markets can offer over a long period of time. So I think more and more of that's going to happen.
So speaking of the digital and physical worlds converging, we got to talk crypto, because Bitcoin at a new record, close to $77,000 per Bitcoin. Update your prediction for us of where you think Bitcoin will go and when, now that Trump will serve another term.
Yes, he's going to be very Bitcoin friendly for sure, including building a strategic reserve of Bitcoin. Senator Lummis has been at the forefront of advocating for that. So very exciting there. Our price target hasn't changed, except perhaps we're leaning more towards our bull case. Our base case is $1 million by 2030. And if you go into big ideas, ARK's big ideas from 2023, in the Bitcoin section, you'll see how we get to that $1 million, the building blocks of it. It's a substitute for gold, so it's digital gold. It is going to be used as a new asset class. It is a new asset class for institutional investors. A very big idea, starting with the spot Bitcoin ETFs launched earlier this year. And of course, we're very gratified that ARKB was one of them. And it's going to be used as an insurance policy, both in emerging markets and in developed markets, against confiscation of wealth, whether that means outright confiscation of wealth by corruption and so forth, perhaps in emerging markets, or by inflation. Inflation's a highly regressive tax. Now, we don't think inflation is going to be a problem with this administration. In fact, we think that the floodgates of innovation are going to open up, and that we're moving into a world tending towards deflation, but good deflation. Technologically enabled innovation is deflationary. So I think many people are going to be really surprised at how low inflation goes in the years ahead.
Kathy, I want to talk performance and get an understanding for where you see the future. because you've seen outflows every month in the ARK Innovation ETF this year, except for this month. It's a year where you're underperforming the S&P 500 by a wide margin. The ARK Innovation ETF, it's about flat. The S&P 500 up more than 25%. What's your message to investors who've lost money with you? And do you worry that performance will lead to an extended period where you won't attract money?
Well, I think, as I've just described, innovation had quite a few obstacles during the last few years. So that speaks for itself. If you look at our performance, let's break it down. You look at our ARKW, which is our next generation internet fund, very focused on AI and digital assets. It's up more than the market this year, more than, I think it's 27, 28%. If you look at ARKG, which is our genomic revolution portfolio, it is down 22%. And a big problem for that portfolio has been the lack of M&A, the absence of M&A. This group, if any, needs those liquidity events because big companies, big pharma companies need the innovation that is coming out of the smaller companies. So we think that's going to change. We also, if you listen to, now I don't know, I don't think he'll be FDA commissioner, but Robert Kennedy, he wants to clean up corruption in healthcare. There are huge lobbying organizations. For pharma. They are not out there advocating for the innovators. I think the most important thing he said is this: we want to go back to the rich tradition of the gold standard of evidence-based science in terms of healthcare, and the tools are here for preventative, predictive, personalized and participatory behavior, healthcare. So I think healthcare, that the convergence of healthcare, sequencing technologies, DNA, RNA, proteins, sequencing technologies, artificial intelligence, and CRISPR gene editing.
So I want to jump in here because, and I'm glad you brought in. I'm glad you brought up RFK because I had a question about that to you, Kathy, and I'm afraid it's probably our last one just because we're running out of time. He's been a vaccine skeptic. You mentioned RNA technology, mRNA technology, what the COVID vaccines, the newish COVID vaccines were based on. Are you concerned that how he views public health is going to affect innovation happening in the space?
No, I'm not. If you read what he said very recently, he sounds pretty libertarian about vaccinations. There are some people who really feel it's important and others who don't, and live and let live. But one thing I'd like to say,
please,
is this past administration has been a menace to what we're calling the multi-omics revolution, which is going to be the most profound application of artificial intelligence and new technologies in history. Going to cure disease, and yet, as I look at the traditional analyst response to these drugs like CRISPR Therapeutics and Intellia that are starting to cure disease, and how they think that's bad business because they don't have an annuity. Keeping someone's symptoms under control, that's an annuity. They prefer that to a cure. In our latest Monday newsletter, it's called ARK Disrupt. You can find it on Twitter. You'll see that we believe that curing disease is going to make the patents of the companies with those cures 2 to 20 times more valuable than those other kinds. So I think there's a complete misunderstanding of the dawn of the new health age. And I am so excited that the Trump administration is going to bring this new world to life for us.
Kathy Wood, we always want more time with you. Thank you so much for spending a big part of your afternoon with us. We do appreciate it. That's Kathy Wood, the founder, CEO, and CIO over at ARK Invest, joining us from St. Petersburg, Florida. A lot's happening in the after hours, a slew of earnings. Fortunately, we got Charlie Pellet all over them to give us an update on business news and what's going on in the after hours.
All right, thank you very much indeed. Lots going on with the Dow lower today. Turned out to be a winning day. Another record for the S&P 500 index. NASDAQ as well. Let's recap, reset on the Federal Reserve. A Fed Thursday today because of the election. S&P up 44, a gain of 0.7%, ending the day at 59.73. NASDAQ up 1.5%. Another record there, 19,269. But not all stocks advanced today. We had the Russell 2000 index of small cap shares slumping after yesterday's surge, down by about 0.4%. Bottom line, Dow flat on the day, down by just about half a point. Your 10-year, 4.32%, with a 2-year, 4.19%. Gold up 1.8% at $27.07 the ounce, while West Texas Intermediate crude 72.06, up by about 0.5%. Fed Chair Jay Powell, you heard him here on Bloomberg Radio, announcing a 25 basis point cut, saying the economy is strong, while refraining from signaling whether the Federal Reserve will skip cutting rates.
At today's meeting, the committee decided to lower the target range for the federal funds rate by 0.25 percentage point to 4.5% to 4.75%. This further recalibration of our policy stance will help maintain the strength of the economy and the labor market, and will continue to enable further progress on inflation as we move toward a more neutral stance over time.
And the other news, Kathy Wood, founder and CEO of ARK Investment Management, wrapping up a wide-ranging interview right here on Bloomberg Radio with words of praise for Elon Musk.
He is the inventor of our age, and he comes into a problem, assesses it with first principles thinking, doesn't care how things have been done, and comes back with, ingenious solutions to big problems.
And today we had Tesla up by 2.9%. The ARK Innovation ETF up today by just about 1%. Again, recapping, stocks higher. S&P at a record up by 0.7%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
Hey, Charlie, do appreciate that. Hey, if you never want to miss a Bloomberg Business Week story, become a subscriber today. You'll unlock deep reporting and analysis from reporters around the world, including unlimited access to Business Week. Check out our offers right now at Bloomberg.com/subscribe now. Well, earlier today, President Joe Biden expressed hope that Americans can, quote, lower the temperature and reaffirm their faith in the election system after a contentious campaign that saw Republican President-elect Donald Trump secure a sweeping victory. The former president did say that campaigns are a contest of competing visions, or the current president, I should say. A country chooses one or the other. He said, we accept the choice the country made. And he said many times, you can't love your country only when you win. Well, it will take some time for the history books to write the story of this presidential election, but Bloomberg Business Week editor Brad Stone offers an assessment today of what propelled Donald Trump to a decisive victory. Brad is a Bloomberg Business Week editor. He's also the author of 4 books, including the New York Times bestseller, Amazon Unbound, Jeff Bezos, and the Invention of a Global Empire. He joins us from our San Francisco bureau. Brad, you write that Trump's decisive 2024 win against Kamala Harris looks less like the polished narrative gemstone it will inevitably become, and more like an unwieldy clump of muddy economic explanations and gross political blind spots. What are the muddy economic explanations? I want to start there.
Yeah, thanks, Tim. And first of all, great interview with Kathy Wood.
Thank you.
Very interesting stuff. Well, look, we always look back on our elections and sort of contemplate a pithy summation of what happened. So Trump in 2016 kind of bringing Americans to reject Obama's globalist optimism. You can go back, Obama, his message of hope after the Great Recession. And so I was really kind of thinking about, well, what are we going to take from this? And the most obvious explanation, the big one that stands out, is that people were just dissatisfied with the current state of things economically. I mean, you had a president deep underwater in Biden, his popularity, his approval rating at 41%, 26% of Americans dissatisfied with the direction of the company. That's the easiest and most obvious explanation. But when I talk about the kind of muddy factors. I mean, there's just so much we don't know. The fact that Vice President Harris lost ground with Latino voters, non-college educated female voters, young voters. I mean, there's clearly something else going on here. And I think it will take a while for us to really look at the data and understand what went on.
One thing that's really striking to me, again, the data is still continuing to sort of come out here, Brad, and there's been a lot of hand-wringing by a lot of different groups here at this point. But turnout just wasn't there, even on the Republican side in terms of gross numbers compared to 2020. Do you have any idea what happened there?
I mean, it's remarkable. I mean, maybe there's a little bit of political exhaustion. I mean, the vice president, talked a little bit about that on the campaign trail. You know, in 2020, the election we're comparing it to, we were in the very midst of the pandemic. You know, maybe there weren't all that many alternatives at the time to getting engaged in the electoral process and voting. There might have just been something about the options and the candidates that voters had that turned them off. So no, I think, when you look particularly on the Democratic side, the depressed voter turnout was a major factor behind the across-the-board defeats.
Brad, you know what's really striking to me, and we actually heard this from Jay Powell over and over again this afternoon. He talked about how good of an economy it is right now. It's firing on all cylinders. Inflation's coming back to 2%. The unemployment rate is pretty in balance with where he wants it to be. That's not the message that I got in terms of this election. That's not the message that voters sent, especially in those swing states. What's the misery index? And explain how you looked at that.
Yeah, Bloomberg had, I thought, a very prescient article about a week ago that talked about how uneven that economic recovery was, and that despite the overall positive kind of macro numbers on jobs, on inflation, on gas prices, that, there are pockets of unhappiness. And we looked at the swing states where, states like Wisconsin or Michigan, Ohio, states that did vote for President Trump, where the misery index, as you say, Tim, that combination of inflation data, unemployment data, is still very high. And so there are things like population declines in some counties, still a stumbling recovery, high unemployment numbers that were clearly fueling the dissatisfaction that may have turned the election.
It's so interesting because it seems like the chattering class kind of thought that presidential candidate who has been accused of so many different things, who has been determined by a court to actually be a felon, 34 different counts, and has had so many struggles, at least with the law over the last few years, oversaw not really what he would say, but no question that he was there on January 6th, and all the comments that he's made about that have been well documented. But that just didn't matter at all in the end to voters.
Well, certainly not to a majority of the voters that turned out in this election. Maybe it did propel some to stay home. It may also be that people have short-term memories. I mean, my colleague Mark Millian writes today in the Business Week newsletter about nostalgia. Nostalgia can be a powerful political force. Make America great again, Reagan's shining city on a hill, evoking these memories. So, nostalgia as a political force, I kind of like the idea, but it also maybe suggests that specific memories aren't as powerful as these vague memories of a greater time, and that in talking about making America great again and all the implicit things in that statement, that Trump is distracting people from the specifics of maybe how they felt about his leadership during the pandemic, how they felt about some of his, crimes, alleged and otherwise, and brought their attention more on, restoring this sense, maybe illusory, that he can help, bring America back to some previous greatness.
So I'm wondering about sort of the lesson. And it's not our job to sort of give a lesson to Democrats here, but as I mentioned, there's a lot of hand-wringing going on, and we've written about that. It's been well documented. But the Monday morning or the Wednesday morning quarterbacking, the shoulda, woulda, coulda, it sort of seems like, in hindsight, some of it actually went back to the current president's decision to continue running until that became untenable.
Well, look, I mean, Tim, I'm not a political analyst by any means, but I would say this. I mean, first of all, the margin of the victory, for Trump was so big that, perhaps any one factor might not have even had made a difference. And two, the Democratic Party, the fact that there is no longer a chance or a hope of changing minds in Ohio, my home state, or Florida, it used to be a swing state. The fact that the Democratic Party doesn't speak to, middle class or lower class voters in states like Arkansas or Oklahoma, where, arguably voters there might appreciate some factors of the Democratic agenda, raising the minimum wage, restoring protections for health care and insurance, that the Democrats rely on, three Midwestern swing states, the so-called blue wall, or hope to turn Arizona or Nevada or North Carolina. It just feels like there needs to be an overhaul, a rebalancing of expectations in the Democratic Party if they really hope to compete going forward.
Yeah, it's fun. You mentioned blue wall, but I've heard people say they might need to change the name of that, given what's happened in the last three elections, whereas Democrats only won the blue wall states in one of those last three, and that was in 2020. Hey, I wanted to talk about with you some of the other stories that you and the team over at Bloomberg Business Week have been highlighting in recent days. There's been a lot of hand-wringing about polling and the idea that every poll that we got, save for a couple polls that people thought were outliers at the time, really showed this race neck and neck, a coin flip. It's pretty remarkable to see. You're the team, Chadwick Matlin and Alex Tansey, argue that even though there was a red wave, we shouldn't be blaming the polls. What's going on here?
I may not be so charitable as Alex and Chad on this one. There is an argument, and pollsters make it, that, hey, the results were within the margin of error, so they weren't technically wrong. And Chad and Alex write that pollsters are often more accurate than they are precise, which to me feels a little bit like, when your football team loses and they still say they played a great game. It's like all these states, all the swing states, sure, they might have been within the margin of error. They're still very close, but they all underestimated Trump's support. They were all sort of directionally wrong in the same way. And then you look at states like Florida or Texas, and they really extremely underestimated Trump's support, well outside the margin of error. And I think that, pollsters still haven't quite figured out Donald Trump's support. This time around, they weighted their results. They tried to account for communities, like, is the respondent in a rural area, or how did they vote previously? And I just don't think they have quite figured it out or gotten it right. And I think, if you made the mistake once again of putting your faith in the polls, you were probably very disappointed last Tuesday night.
Yeah, that's a good point. And in the outlier polls that I was talking about, I mean, there have been these, sort of hopium polls for Democrats out there, like the one we got Saturday night from Ann Seltzer that showed that Vice President Harris was actually leading in Iowa by a margin of 4.
What did she lose, 14 points?
Yeah, it wasn't even close. So it's pretty remarkable to see that. Do you think, Brad, that we have to, as Americans, have to adjust the way that we view polling, or do we have to figure out a better way to poll? Because it just seems like, and Billy House was talking about this earlier on Bloomberg Radio, he would speak to people wearing Trump gear in some states, and they wouldn't tell him who they were voting for. They were even skeptical of someone like him, despite the fact that they were signaling it to the world.
Yeah, I mean, my opinion is it's a broken science. It relies on a voluntary response from people that are now connected in all sorts of different ways. We're all besieged by text messages and spam and other kinds of unsolicited email, and so most people's instinct is to kind of reject an unsolicited query. And, and then you layer on top of that we live in such a polarized environment that some people don't want to express their opinion because they might be, they might feel judged by their community. And so I think, the polling community needs to kind of come together and figure out if there is a path forward. And then, as voters, as in the media, as the electorate, I think that relying on polling right now is very dangerous.
Help us figure out the path forward a little bit, the best you can. Not asking you to make predictions, but you are one of the few people who has sat down with President-elect Trump in recent months. You did that down at Mar-a-Lago for a Bloomberg Businessweek cover story that really covered pretty much every gamut of the economic agenda of the president-elect. Give us an idea of how you view, if any, his agenda has shifted since then. It was before his assassination attempt, it was before the convention, it was before his selection of J.D. Vance, and it was, of course, before he won the election, versus what you've heard from him now, and how he puts that into action in the coming months during the transition, and what that looks like January 20th.
I mean, Tim, I just have no idea. Look, he might have all the branches of government. He's feeling extraordinarily empowered. He's feeling totally vindicated. There will be no checks on the appointees to his cabinet, to judicial postings. You know, at the same time, like my impression of him when we did go down there in July and just watching him over these past 10 years is that, you know, he does see himself as a man of the people. He wants to be liked. It's extraordinarily important to him to be liked and respected and admired. And I don't think that impulse goes away now that arguably he's not going to ever face election again. So when it comes to some of the things that he's proposed, you know, mass deportations or tariffs that could, you know, according to economists, raise the rate of inflation. You know, he's not going to have any practical moderating influences, but, you know, he doesn't want to, I don't think it's in his nature to want to do broadly unpopular things. So I do wonder if that will end up being a check on some of his instincts. Although, you know, the one thing that we heard from him on Tuesday night was he said, you know, promises offered, promises will be fulfilled. So I do expect him, you know, to come into office looking to immediately put points to the board and to fulfill some of the promises that he made on the campaign trail.
Look, I'm not going to ask you to give up what you're talking to your reporters about in your editorial meetings, but you have a job that requires you to think pretty clearly about what things will look like in the next few months, because you're responsible for assigning stories and understanding what people are going to be talking about in the future. How are you thinking about covering the president-elect?
We're going to be looking very precisely at the challenges and battles ahead for the new administration, and we have reached out into the Bloomberg newsroom around the world to look at, you know, what is ahead in Europe, in China, in immigration, cryptocurrencies on Wall Street and in tech. You know, we were thinking of it in terms of the battles ahead, and it'll be interesting now because I'm not so sure there will be battles. You know, Trump isn't going to have a lot of political opposition if he does control all three branches of Congress. But, you know, certainly we saw today Gavin Newsom calling a special legislative session in California. A lot of the states girding to try to put checks on what the administration will do, either legislatively or in the courts. And so that's our approach, you know, to cover it carefully and to try to look forward rather than back and look at, you know, what the Trump agenda will look like and what it will mean for business.
Well, we look forward to following the story closely and following it at Bloomberg Business Week. Brad, really appreciate you taking the time to join us this afternoon. Brad Stone is Bloomberg Business Week editor. He's also the author of 4 books, including the New York Times bestseller, Amazon Unbound, Jeff Bezos, and the Invention of a Global Empire. If you do want to subscribe to Bloomberg Business Week and unlock deep reporting and analysis from our reporters around the world, including unlimited access to the magazine, check out our offers right now at Bloomberg.com/subscribe now. Coming up next, we're continuing our coverage of this historic election outcome. We're going to talk a little bit about the president-elect's expanding financial empire. That's next on Business Week.
You're listening to Bloomberg Business Week with Carol Messer and Tim Stenivek on Bloomberg Radio and Television.
It is Bloomberg Business Week, and what would you like to hear about on Bloomberg Radio? Help make shows like ours even better by taking our Bloomberg Audience Survey. To do that, you just got to visit youtube.com/Bloomberg Podcast. There you'll find the link in our profile or community section, and you can take the survey there. It's hosted by our partners over at Material. Fill it out now at bloomberg.com/Bloomberg Podcasts. Well, Trump's victory will bolster an empire that spans media, real estate, and crypto, and which to a large extent relies on his image, his brand, and most of all, his political power. Coupled with an ability now to impede the multiple legal entanglements that threatened his business and his freedom, the outlook for his many ventures has never been brighter. So writes Tom Maloney, who's Bloomberg News editor. It's today's big take. You can read the story on the Bloomberg terminal and also at bloomberg.com/big take. He joins us here in the Bloomberg Interactive Brokers studio. Just set the stage for us in terms of how his wealth has changed just since he's, not just this week, but really since, I think, Truth Social went public. That was kind of a big part of it, I think, it seems like.
Yeah, absolutely. Look, that's his most valuable asset, and it's been basically his most valuable asset since it went public in a SPAC merger. It's worth more than $3 billion pre-election. On the night of the election, once it became clear that he was going to become president, the price of Truth Social spiked, or Trump Media and Technology spiked 60%, and that added $2 billion to his net worth. So, look, it's his biggest asset, it's his most liquid asset, and I think it's the kind of, I guess, the clearest indication of what the value of the presidency means to Trump's fortune.
It's interesting. It's because we're calling it an asset because it is an asset, but it's still, as you note at the top of your piece, it lost $363 million in the first 9 months of 2024 on just $2.6 million of sales. Look, we're not here to be financial analysts, but I think it would be fair to say that this valuation is detached from reality.
Absolutely.
Or fundamentals.
Yeah, absolutely. And look, that came in a period when there was an election going on, and you would think if Truth Social can't make money during a quarter when there's an election featuring Donald Trump, when is it going to make money, right? So yes, this thing has been a sort of a meme stock that's traded away from fundamentals based on a kind of really Trump's political fortunes. It is worth noting that since then, it's gone down. Today, it's down substantially. It's down lower than where it was pre-election. So it's still kind of up in the air what is going to happen to the value of this company. But I think we can look at other assets that are in Trump's fortune and talk about the way that they could benefit from the Trump presidency.
So let's do that. And I want to start with real estate, because we all remember what happened to the D.C. hotel during the first Trump administration. It was widely reported on what the rates there were charged. What about a place like Mar-a-Lago now?
Mar-a-Lago is really an interesting one, and I was thinking about it the other day. I think before he ran for president, not many people knew what Mar-a-Lago was, where it was. Now it's got to be one of the best-known pieces of real estate on the planet, right? It's been in the news so much. It's really a kind of an icon now. And before he ran for president, memberships at Mar-a-Lago were going for $100,000. Now they're $1 million. So that just kind of speaks to really translating Trump's political power into money at Mar-a-Lago.
What about when it comes to the crypto ventures? Because and I use the plural because there are a few of them.
I mean, look, Trump's always been known for trying to use his brand to launch various types of products. And I think the most notable way he's done that recently is through crypto. First with non-fungible tokens, and these were kind of digital trading cards that featured his likeness in various poses, wearing various costumes, and he was selling them for like $99 a pop. And they brought in like $7 million, according to his most recent ethics disclosure. And then more recently, there's World Liberty Financial, which is a sort of a crypto lending platform.
It's a hard one to describe because I don't think anybody actually knows what it does.
It doesn't exist yet, but they've sold millions of dollars worth of tokens to help build it. And it's going to be worth money to Trump, and certainly him becoming president makes it more feasible as a business in the future than it would have been if he'd lost.
We talked about some of the real estate Mar-a-Lago, but I want to go outside of the United States and talk about some of the foreign investments that the president-elect has, and the power that comes along with those. What did you find?
Yeah, look, after his first term, he signed a number of licensing deals where the Trump name was used in developments around the world. So places like Oman, Saudi Arabia, Vietnam, India. So they've brought in millions of dollars for the Trump organization. Him winning the presidency just enhances the value of the Trump brand and makes those kind of deals more feasible in the future. What's going to be interesting is to see what he says about doing foreign deals this time around. Last time around, he said he wasn't going to make any foreign financial deals during his first term. It's not kind of clear what's going to happen this time around.
And very briefly, just 30 seconds left, 40 Wall Street here in New York. I wanted to save this one for last. It's a kind of an iconic building down on Wall Street.
Yeah, it's a beautiful building, 1920s Art Deco office building, but it's got a lot of issues. Obviously, look, office real estate is not doing all that well in North America. Occupancy is way down. This place is not making enough money even to cover its interest payments. It's also got this ground lease, which is a big problem. Oh, yeah. It's going to get more expensive, so that's got to be renegotiated at some point. But the point that we make in the piece is you'd rather be president and you're in a bully pulpit there.
Tom Maloney, Bloomberg News editor. Check out his story. It's the Bloomberg Big Take. That does it for Bloomberg Business Week.